the recurring revenue. So what do you take from the Bucks experience that you will employ or deploy in this fund environment? What's the biggest lesson?
Sorry, I have a bit of a cold. I think it was a great experience. I absolutely loved it. You got to play fantasy basketball every day, which I think was one of the best things I've ever been able to do in my life. I think you got to be part of a great organization. I think Adam Silver is a phenomenal commissioner. You got to be partners with 29 other individuals. So I think you learned a lot. You compete against people on the court, but at the same time, you're actually partners in the whole. So I think for me, the experience was unique. I've been able to use that experience and that knowledge to now translate to do other things in sports. Mm-hmm. We turned a team that was the worst team in the league, that literally within 5 years, we ended up having a championship team. Thank you so much. Yeah. And that's pretty unique, right? When we won the championship, the NBA comes to you and says, you're gonna go on national TV and you're gonna hold this trophy up. And you're like, oh yeah, that's no problem. And before I go, my son says to me, he goes, Dad, just so you know, it's really heavy. Whatever you do, don't drop it. And now the only thing I'm thinking is, how heavy is this stupid thing? Did I work out? What have I done?
Right.
I gotta and they say to you, I'm like, oh, great. And they go, look, you get the trophy, and then you lift it over your head and you walk around to show it to everybody. And I'm like, okay, and the only thing you're thinking is how heavy is this thing? So Adam Silver gets the trophy and he hands it to me. I'm like, well, it can't be that heavy. And he gives it to me. I'm like, fuck, it's sorry. Sorry. It's really heavy. And, I pick it up and I'm lifting it. You're going slow because you obviously don't want to drop it. So afterwards, lifting, it's all good. Everybody screams. I must have gotten 1,000 texts that day afterwards. And, the bunch of people are like, looked like the trophy was heavy. You were having a hard time lifting that thing up. And really, I respond, no, it's not that it was heavy. I just didn't want to drop it, so I was going slow to make sure. But on TV, it looks like, So, yeah, but it was a bit of a unique experience.
Yeah. And so what are you most excited about investing in? I mean, you mentioned women's sports, but take me a level down. What's the analysis that you're doing? You talked about the media rights, but what's the secret sauce that you can bring? Because you got more and more people getting into this. When you guys bought the Bucks, it was a little bit novel. Now it feels like everyone's trying. I mean, we're talking about sports all day, today and tomorrow.
So, I think what I've learned, I can turn that into trying to make teams into championship teams. I'll give you a good example. You could today, so I would like to go out and buy teams in Africa. I want to buy basketball teams in Africa. I think Africa today is it's where the league was in the U.S. 10, 20 years ago. You want to do the same thing in Asia. You want to do the same thing in India. You can do very similar things in Europe with EuroLeague. There are these massive opportunities out there that really need someone who understands what it's like and what you need to do to win a championship, but what you need to do to win. And so you can take your business experience and you can take your experience owning a team, and when you put the two of them together, there just aren't that many people who've really done that. And I think that'll end up being a little bit different and hopefully be unique and enable us to do things that others have not.
Well, I could talk to you all day about this stuff and look forward to our next conversation. I'm glad you didn't drop the trophy.
So am I.
And I'm glad you're invested in pickleball too, and we got to talk about that. Thank you very much for your attention. Thanks, Marc.
Please welcome to the stage Saba Capital Management founder and chief investment officer Boaz Weinstein with Bloomberg's Lisa Abramowitz.
Tell me what you're waiting for. Look across the great divide.
Hello, welcome. I'm so pleased to be here with Boaz Weinstein. Some of you may know who he is. He is the head of Saba Capital Management. He rose to prominence both as a derivatives trader at Deutsche Bank and then, of course, in 2012, being on the opposite side of the JP Morgan London Chief Investment Officer office, which is known as the London Whale, and has since won this year's Institutional Investor Top Credit, as well as activist hedge fund managers. He is here, and I've got to say, he is here the day after his 50th birthday. Boaz, I want to start with, it's been 35 years. When you were 15 years old, you fell in love with Wall Street. What's changed since then?
You know, turning 50 does feel different, in case anyone's wondering who hasn't done it yet, than 49. And so I have been reflecting a bit. I thought about how I started on Wall Street. I was very lucky to get a job my sophomore year of college at Merrill Lynch after school, full-time in the summer. And I basically spent those years with thinking about Wall Street, being on Wall Street, and playing chess. And I woke up yesterday, a little bit earlier than the rest of my family, and I played 5 games of speed chess and thought about Wall Street. And I realized, like, for me at least, 35 years later, basically nothing's changed. I'm still very passionate about Wall Street. I'm still passionate about chess, and that's who I am.
Well, how do you play chess at a moment like this, or how do you use some of the lessons at a time of such incredible uncertainty when everyone's trying to figure out what the parameters are to even trade within?
Yeah, so, you know, chess is attributed to thinking some number of moves ahead and seeing the future, and I think it's great for a lot of things. It's great for concentration, it's great for planning, but I feel like this market, you know, we have this heavy fog outside thanks to our Canadian friends, and we have, I think, a big fog. We have a big fog in the market because, you know, the bond market was pretty sure that the Fed was done like a hike ago, and now and this one was a mistake. But all of a sudden now there's maybe going to be another one or two to come, or 50 in July, and so the market is constantly wrong, and individuals are wrong. Team transitory was said with confidence and then wrong, and I think we just have to accept that there is a thick fog right now, and fixed point prediction. This will happen, that will happen, there won't be a recession, there'll be a hard landing. Those, you know, thinking about chess to figure out 4 moves ahead isn't really the right game. I think it's much more apt to think about poker, where you have an opponent and you raise, you bet, they raise, you re-raise, they go all in, and now you have to think, what do I know? What's the range of hands that they could have? Could they be bluffing? Might they have anything other than pocket aces, for any of you who know what I'm talking about? Or might they have any 2 cards? And so I think right now we're in a almost any 2 cards kind of scenario. There's a lot of chances of different outcomes. And instead of saying, I think there'll be a recession or I won't, or there won't, which I kind of howl at the TV screen when I hear that, I feel like you have to think about ranges of outcomes. And even if, you know, I listened to Stan this morning, his comments were amazing, like you go with 40% chance of recession, or Goldman just shifted to 25. The point is that you could have a 40% chance of something happening and still want to make the investment that it happens because it's priced at 5%. And the way I look at credit right now is that there's almost no chance of a real pickup in defaults priced into credit spreads. And so through that range of outcomes informs our investment view, which is that the market, whether you look at the VIX or credit spreads, is not ready for that uncertainty.
Okay, just a full disclosure, Boaz was banned, I believe, from a Scottish poker house for counting cards. Was that correct?
So different game. So we talked about chess.
Oh, that was blackjack,
There's
right?
poker. I happen, in my misspent youth, learned to count cards very well. And a Greek casino on Baker Street in London gave me a letter that Lisa saw when I was late to our meeting that said that I'm no longer allowed to enter on, I think it's 10 Baker Street, or maybe that's Sherlock Holmes. But either way, I'm not allowed to enter, and that's a different game. That's a game where you have every piece of information. There's no uncertainty. What are the odds? And so forth.
So let's dovetail that into how to get an upper hand at a time when you do have this arbitrage, this fog, and you're trying to come up with what the right parameters are. How do you know what's mispriced? How do you know where the probabilities are? What sort of do you look at to make some convictions?
Yeah, so I've always gravitated to arbitrage strategies, not about predicting what will happen, but just security A against security B is mispriced. And actually, by you accidentally mentioning blackjack, just reminded me that Ed Thorpe from Beat the Dealer or Beat Wall Street, this famous MIT professor. If you're watching, it's a bucket list item for me to meet you. And he's still going strong. So he, in the 1980s, did a kind of arbitrage called closed-end fund arbitrage. And I know that Warren Buffett, when in 1950, before he took Benjamin Graham's class, he sent me in 2018 his position report that the majority of Warren Buffett's holdings when he was about to enter that class were discounted closed-end funds. So I'm interested in arbitrage, and closed-end fund arbitrage is the thing I'm most interested in today because it is tangible. It's an arbitrage that you can actually collapse yourself. You don't have to hope that Elon Musk buys Twitter in merger arbitrage. In cap structure arb, you have to hope the company behaves a certain way or certain outcomes happen. In closed-end fund arbitrage, you can actually control your destiny. So maybe I can tell you why I'm very excited about that now.
Yeah, so closed-end funds, let's just explain. You basically IPO a fund, for anyone who doesn't know, and you sell shares, and then you take the money and you can invest in whatever you want, and the shares should trade at the same price as the IPO or even higher, unless there's some kind of dissonance that you don't feel like you're going to get all your money back. So why are you seeing an opportunity right now in this sphere?
Right. So closed-end funds, open-ended funds, we typically know more about open-ended funds, so mutual funds or ETFs. If you want your money back, you're going to get NAV. It is a arbitrage on an ETF, and in a mutual fund, they'll sell you a little bit of the portfolio. They'll sell a little bit of the portfolio. They'll give you back NAV. You're tethered to NAV. You always get NAV. In a closed-end fund, and there's 770 of them on the New York Stock Exchange and the London Stock Exchange, you have to sell it to someone else. And that might be at a 30% discount to NAV, a 2% premium, and everything in between and more. And so closed-end funds can sit at huge discounts for a very long time. As we talk here today, about 3/4 of the market, the closed-end fund market, which is about a $500 billion market, is trading just fine. Small discount, no discount, premium. But a quarter of it are trading at gaping discounts. And so I look at it like I'm buying dollars for 80 cents. I'm buying $1 for 80 cents. And unlike most investments where you have to think, what's NVIDIA worth? What's the economy going to do? Here, we just have to think, can we cause that 80 cents to go back to 100 through our rights to elect a board that cares about those things? The board is, of course, supposed to be operating to the benefit of shareholders, and they have a magic button. They can press a button to turn their closed-end fund into an open-ended fund. They could turn it into a mutual fund, an ETF. They could tender for shares. They could even liquidate, and they can make that discount go away. That discount today across closed-end funds, $60 billion.
Okay, you're bearing the lead. You've declared war on BlackRock. What are you trying to do here?
So, well, I wouldn't call it war on BlackRock. We've been investing for a decade in this space, and funds that are at structural discounts, that are at double-digit discounts, 15, 20% discounts, even if they hold something as benign as California muni bonds. In the case of, for example, BFZ or MUC, those are two BlackRock California closed-end funds. And in 2020, when we had a mini skirmish with them, on New York muni funds, they just merged them into their New York muni open-ended fund, and every single investor, including the employees at these firms, benefited because they're eating their own cooking, and everyone won. But the reason there's a battle, the reason you called it a war, is because at the upper level of management, which is really the only place where there's any pushback, they would like to keep the money trapped because they'll get a higher multiple from the stock market if it's in closed-end fund form that they can keep forever versus an ETF where the stock market will say, well, people could redeem from that. And so we have 3 live campaigns. One of them is super ironic because it's a campaign on a ESG fund. The ticker for that is ECAT, E-C-A-T. There's a fund called Big Z, which is like Cathie Wood's ARK. It lost, since its IPO in March 2021, it lost 54%. And then a California muni fund, BFZ. If they turned those funds into open-ended funds or conducted tenders at NAV, every single shareholder would win, and that is $580 million to all shareholders from them pressing a button.
How much has your portfolio of closed-end shares increased as a share of your overall holdings?
I, in the past year, have been amazed at how the discounts for some of these funds have ballooned out to 20 cents, 20% discount, and we, in our flagship fund, are 46% invested in closed-end funds. And particularly with BlackRock, because they are the world's largest asset manager, because they are talking the talk on ESG, they're saying, this is how we want to be treated when we are shareholders in IBM or Disney or what have you. I believe they have to walk the walk. They cannot use entrenchment mechanisms to prevent us from putting people on the board. And I'll just say that they're a thought leader, but what they are doing to entrench with respect to stripping shareholder rights, banning shareholder proposals, which they've done, puts them on the G side of governance as the worst company in the S&P 500.
So taking a step back, people might say they came here thinking that you were going to come here and say the world is falling, credit's going to fall out of bed, bet against it, these sort of broad proclamations, and instead you're finding these sort of nuanced trades that you can arbitrage out right now. So I'm wondering, how do you find more comfort in some of the market technicals and sort of that aspect of the market rather than the fog? How do you sort of dovetail investing in, basically Cathie Wood's fund because you think that it's a correct discount without understanding sort of the broader sphere of things?
Very, very fair. So it is quite easy. In fact, BlackRock's incredible success as a firm, they have lookalike products that are ETFs, and you can hedge that. You can hedge the closed end with the underlying exposures, like Ed Thorpe used to do in the 1980s, or you could or Warren Buffett thought it was cheap enough that he would hold it just outright. Or you could actually find one of these ETF lookalikes. There's ECAT on the BlackRock side, and then there are multiple multi-billion-dollar ESG funds that are mutual funds that trade at NAV, that are great hedges, that are great merger partners for BlackRock. And so we can eliminate the market exposure and isolate just the discount. And to your question, how do we navigate technicals? Don Fitzpatrick was speaking today about how attractive agency mortgages are, and Dan Ivison yesterday about how amazing agency mortgages are. That we have Fannie and Freddie trading at wider spreads for a couple of reasons. One of them being technical, purely technical, than even BBB corporates. So how to navigate technicals? I feel like it's become way more important in this environment, and technicals can sting. That technical can remain. And so one thing that's great about the closed-end strategy is it's a closed loop. You can elect a board that cares to press that button and repatriate in those three funds only $580 million.
Do you also think that the technicals are attractive for agency mortgage-backed securities?
I think they're, for the reasons Don mentioned, unattractive. You had 2/3 of the buyers of these products now actual sellers. You have, BlackRock, for example, selling on behalf of Silicon Valley Bank. You have the Fed in almost in QE type of terms, or not QT, not QE. And so you're up against this technical. The technical has created the cheapness, and the technical may very well remain, but it's a very different world. I think it's true for meme stocks as well. We saw it's not about what fundamentally a stock is worth. It's about what are the technicals, when might the technicals change, and that's the biggest driver to me of asset prices in my career.
You talk about technicals, and that really raises a question of the fragility of markets and kind of market structure at a time when you have seen real concentration in a number of funds, and it seems like there is more kind of massive swings in certain areas. Do you feel like this market is more fragile or less fragile than it was a couple of years ago?
I think there's a real fragility which showed itself March 2020 when all of a sudden the bond market and even ETFs were in free fall, and it was really because of this supply-demand imbalance. When I started in the business, it was almost inappropriate to think that a mom-and-pop investor would own junk bonds or CLO tranches, but now with the rise of the asset management industry bringing these products. We just heard today Henry Kravis speak eloquently about bringing private equity to mom-and-pop investors, and that's really double-edged because if it's in a product where they can sell on a day's notice or no day's notice, it can create real challenges. Or if there could be an avalanche because somebody gets their leverage cut in the private credit market, and then someone else has to sell. So I think that the fragility remains. It's been tamped down by the incredible accommodation that the government made during COVID, but the danger is still lurking.
Do you think that private credit is an area of substantial risk? Do you think it's in the real estate sector? Do you think that it's just in sort of public credit? Is there an area that you think is most mispriced right now?
I think that private credit gets an incredible amount of airtime, including in today's conference. The speaker before, Marc Lasry, I've heard him on Bloomberg speak about how incredible the opportunity is to make secured loans at 13%. Now that does sound incredible, and you can withstand a pretty high default rate. Now flip it around to the person, the company that's borrowing at 13%, maybe into an economic slowdown, maybe into a world where that 13 will turn into 13.5 because the Fed is not done hiking yet. You have this base rate that has gone from 0 to 5.25, 5, and it's headed higher. If you believe, again, the experts that I have, I don't know what I believe other than to keep a wide range out there. And so private credit, which was a cottage industry a decade ago, $250 billion, is now 1.4, 1.5 trillion. And a lot of those companies are going to suffer under the weight of those interest payments. And it is almost for sure, recession or no recession, that the default rate is going to rise. A few weeks ago, 8 companies defaulted over a weekend, including one in your industry, Vice Media.
Carry on.
She looked a little too happy by the way.
I'm not happy about it. I'm just, carry on.
So I think that private credit's full of opportunity, but it's also going to be full of risk, and there will be some potential chaos should it be met with also a slowdown in the economy.
One of your big lures for your fund is as a tail risk fund, and as one that is seeking to preserve capital and then also do well. And I'm wondering, how many investors have come to you recently who are still incredibly bearish and trying to figure out how to preserve their capital and sort of make a profit on it in the way that you're advertising?
Yeah, it used to be you had to find a bearish investor that wanted to invest in tail, and we could not be easily fit into a box. You mentioned we won the Credit Fund Award, but if you look through our portfolio, though it heavily uses credit products, we're really a long volatility fund that will perform well in a bearish market for credit, for equities. And it used to be hard to find investors that really wanted it. But there's been such a change where U.S. endowments, pensions, European investors, they're not looking at it because they're bearish. They're looking at it to say, first of all, is the cost pretty attractive, which it is now, and you think about all the problems in the world and the relatively cheap cost of hedging them. What is your unique brand, if there is one, of how to accomplish that? And then they're thinking about it like, how do I make some money so that if the market sells off hard, instead of having to sell, I can be front-footed, I can redeem from you, take that money and invest when there's tremendous scarcity for going long, when everyone else is trying to sell, like we saw in March 2020. And so they've been, I think, conditioned already to think about it like a way to protect against, problems that they would face in that sell-off, to instead be aggressive to buy the dip. And tail funds, I think, accomplish that pretty well.
We only have about 90 seconds left, and I'm sure that you spend a lot of time just sitting there thinking, what am I not thinking about? How do I see around corners at a time when it's your job to do that? So what keeps you up at night now? I mean, what's your biggest concern as you look around at how we're set up?
For the economy or for my own positioning? Well, very different answers.
Both.
Okay, so I think that people have been cautious for a long time. It kind of comes out of the COVID mindset, and you could see a lot of fear in the market. We had Ukraine, we have inflation, we have all sorts of senior loan officers starting to slow down on lending, and you can kind of see these problems. But at the same time, then you see this jobs number, and it's very strong, and you see signs of life. And so I think people are tired of being defensively positioned, and probably have felt some temptation, especially with this AI boom, to say, look, maybe we have to move out of T-bills back into risk. And I think T-bills are so attractive, because wouldn't it be beautiful to stay conservatively invested if you had to be long, with that dry powder, if you're not in a tail fund, to sell those T-bills and move in when there has been a real reckoning. I feel like the market is tired of being bearish, and so to have now, looking at just the front month VIX, for example, the fear gauge, to have that now at its lowest point since a month into COVID, or sorry, 6 months into COVID. So almost 3 years now, the lowest point seems kind of wild when you think about all the uncertainty that's in the market. And so I think this is a time to be cautious, because the pricing, leaving aside some AI stuff that can keep going, the pricing is not there, and we should continue to be cautious, even if that's a little bit boring.
Boaz Weinstein, thank you so much for taking the time. Always a pleasure having you.
Thank you, Lisa.
Please welcome to the stage PGIM CEO David Hunt and BNY Mellon Investment Management CEO Hanneke Smits with Bloomberg's Amanda Cantrell.
All right, well, thank you so much, everyone, for being here today. We've already heard a lot of compelling viewpoints on private credit, commercial real estate, AI, and we're going to tackle all of those and more right now from the viewpoint of two CEOs who control about $3 trillion between them. We have David Hunt, he's the president and CEO of PGIM, which manages about $1.3 trillion, and Hanneke Smits, she's the CEO of BNY Mellon Investment Management, which manages about $2 trillion. So thank you both so much for being here.
Thank you for having us.
Great to be here.
Thank you. So I thought we'd just start by, looking at the session title, Today's Assets, from Safe and Secure to Risky and Untouchable. So let's start there. What do you see as untouchable right now?
Shall I kick off?
Sure, go right ahead.
I think first of all, it's all about context, right? So we're sort of entering what we consider to be a new normal, higher rate environment, and I think historians in decades to come will look actually back on the previous sort of decade and a half and realize that was actually not a sort of normal environment of very low rates and the quantitative easing, which had a real impact on valuations of equities in particular, and also of yields that were very, very low on bonds. So I think the environment that we're entering will be more attractive for bonds. You're going to see yields, and we've already seen that increase. We expect greater interest in fixed income. And we actually also think that equities will be priced more appropriately because they will be priced based on their earnings outlooks rather than being underpinned by the supply of money. So when you sort of say what is untouchable, we would say in any type of environment, you're always going to find a particular security in a particular asset class that is a security you don't want to touch. But that is why for us as an active manager, it's really important to highlight the importance of research that our investment firms conduct, both on equities as well as fixed income. So from an asset class perspective, we wouldn't say that there are untouchable asset classes, but within it, it is going to be about nuance. So in equities, it's more likely about value than growth. But again, in growth, if you target it well, you can still find growth companies.
David?
So I'd add a couple points maybe to the context, because I do think that we all suffer massively from kind of home country bias. And it's very hard to generalize around the world. We're in very different places in different countries. I just spent in April 2 weeks in Asia, and Japan has just actually put its head above the parapet with a little inflation, and they couldn't be happier about it. Actually, they've got a little bit of growth, and you've never seen people so excited. And China is actually disappointing to the downside, and actually, I think, really having some difficult times getting their growth engine started. Europe, I spent a week there just a week before last, and at least by our measures, is probably now in a mild recession already. The UK struggling. And then you come to the U.S., which I know everybody loves to cover, but it's a completely different situation where you actually have a government that has pumped far more money, I think, than people realize into the economy. We think there's still more than $1 trillion of excess savings that are sitting there. Consumer spending continues to be very strong. And our view would be that inflation is going to be high, and therefore rates are going to be higher and for longer than is currently priced into the market. But when you take that picture together, the world's in very different spots. And I do think that it's never been more important to have an active manager who is actually looking very carefully at the local context. Because generalizations by sector simply don't work in this environment the way that they might have a few years ago.
So forgive me then for asking you about a specific sector or a particular asset class, but I do want to touch on private credit because it's it's come up a lot today. We write about it constantly on the terminal. There's a flood of cash coming in. How do you view private credit?
So I think private credit is an interesting asset class, and certainly with what we've seen in the recent environment with the banking crisis and the conditions for banks tightening, there's been a surge of demand for private credit. I don't think that there is yet a bubble or froth emerging, but it always depends, of course, always where you are, whether you're on the buy side or how much exposure you have to assets or to loans that you've already extended. Default rates are still relatively low. Certainly when you look at that on historic levels, we do expect them to go up, but not by as much as might have been predicted. And when you look at the size of private credit, while it has trebled over sort of the last decade, the pool is sort of on par with high yield and is not inconsistent with what we think right now is needed in the environment with some retrenchments on the part of the banks.
Mm-hmm. So David, you're firmly...
So I would just maybe broaden the question a little bit to private assets. So at PGIM, we manage about $300 billion in private alternatives overall. That's certainly a large real estate business. We're the third largest real estate investor in the world. But it's also a big private credit business. So we have about $100 billion in private credit, and that's been our fastest growing asset class for sure. And I think people often look at that and they wonder, where is this new asset class kind of coming from? And it's exactly as Hanneke says, it's not a new asset class. It's just that a lot of this financing used to come from the banks. And following the GFC, where obviously they had to hold a lot more capital against these loans, they really pulled back. That combined with the real collapse of finance companies, which is another whole set of asset classes that used to be financed through banks and through corporations, is now being done by private investors. So we think that we're actually at the moment in the fairly early innings of all of these asset classes coming to the private markets. So we can imagine, while there'll be some ups and downs, and I'll point out some of the downs in a moment, but we can imagine this asset class actually continuing to grow for the next decade as banks find it more and more difficult. This used to be mostly a U.S. phenomena. It's now actually, one of our largest markets is the UK. We're seeing it now on the continent and in places like Australia. But with all of that, I would say that a lot of this growth has happened in a period where we have not had a good old-fashioned credit crunch. There will be a bit of a shakeout. Our model is actually to have regional offices in all of the cities around the world where we call directly on middle market companies. We get to know management, and we think our ability to underwrite and to partner with them through a cycle is very high and distinctive. We are not simply brokering loans from the sell side. And I think that's an important distinction. I think many of the firms that set up more recently, who are sort of taking calls from the sell side and doing a lot of agent deals, they are going to struggle as we go through this next downturn. But a little bit of a shakeout is probably no bad thing. But that is in the context of a broader cyclical trend where this will become much larger than it is today.
Do you worry, though, that the amount of money that's coming in from competitors as well is outpacing the opportunity set that's there right now?
At the moment, no. I mean, our originations are running ahead of kind of what we've been able to handle. So I would say, at least at the moment, that hasn't really happened. I suppose it could do, but for the most part, private assets have suffered a little bit from the denominator effect in many institutional investors' portfolios, where their public bonds and stocks have fallen enough that it's hard for them to be reallocating. And so what we're seeing is actually a big growth in our secondaries business, because we're actually now buying GP stakes and LP stakes out so that they can recycle more money to go back into the private markets in new vintages. And I think that that's an important trend that will play out over the next couple of years as well.
And Hanneke, to switch to another completely different asset class, albeit one that you referred to earlier, growth equity. This is something that came up, when we were having a conversation prior to the panel as an area of potential concern for you, growth equity and venture in particular. What are the risks there, and what do you make of the current marks of a lot of private companies?
So I think when you look, so again, it's all about context, right? So when you look at the current macroeconomic outlook and the cost of the rise in the cost of capital, the collapse of Silicon Valley Bank and some of the other regional banks, which are very important to the VC and growth equity infrastructure, I think that asset class does face some headwinds. Now, notwithstanding that, I think we need to keep in mind that those portfolios are still relatively small as part of institutional and retail portfolios, right? These are exposures that investors have in the context of larger private asset allocations, but they will certainly not comprise the largest exposure. So, but I think some adjustment from a valuation perspective is appropriate, and that can actually provide good opportunities for buyers in this environment. There may be some exposure and actually opportunities for those that perhaps in the secondary market, as David alluded to, through the growth and venture lens. Now, having said that, where we remain cautious is actually more broadly on the earnings outlook, because when we look at the portfolios that we manage for our clients, they broadly continue to have exposure both through our active equity strategies as well as through the indexing business to the equities markets, right? And the earnings outlook, I think we all would agree that the earnings season for the first quarter came out better than expected. And this was also in particular, I think, here in the US on the back of continued good economic growth. The earnings outlook has also not on the whole been revised upwards, right? The drivers of growth in the markets are around technology, in particular around AI. I know we're going to maybe talk about that a little bit later. So it's very specific, but for the broader sectors and for the broader index, we have yet to see an upwards revision to the earnings outlook. And I think when you then have the context that David just outlined of global companies that have exposure not just to the US, but to other parts of the world where some of the outlook is perhaps a little bit more mixed. You're going to see maybe tighter labor markets. You're still going to see the inflation impact on the expense lines of companies. There will be some margin pressure. That's where actually we remain somewhat cautious. Notwithstanding that, we do find good opportunities in equities, but you have to be very, very targeted, which of course is what active managers do.
I definitely want to come back to AI later, but David, I don't want to miss the opportunity to ask you about commercial real estate. PGIM is obviously a very large holder of commercial real estate, and different subsectors within that asset class are facing very different fortunes right now.
Yeah, because that would certainly be my answer. I actually think that growth equity and venture have sort of taken it soundly on the chin, and that's not so much where I worry about marks. I worry about the marks now in private equity books, particularly ones that are leveraged, and in real estate. Real estate marks have not really come down sufficiently, and I think that we are going to see an important move downward in many real estate markets. I will make a couple of points of context in that, though. First, when people ask me about real estate, actually they're asking me about office. But the two shouldn't be conflated. Many parts of the real estate market are actually doing very well. Multifamily, which is probably our largest holding, is actually holding up extremely well. Rents are doing fine. We're not having a lot of problems with payments. That remains a sector that's very, I think, robust. And we don't have enough housing in the United States, in the UK, and in many parts of the world. So we've been underbuilding for decades. And so I think that the long-term trends in that remain very good. Industrial remains very strong. Some of that has moved from, kind of the big boxes on the periphery of cities to where it's now last mile. But that is also a very strong sector. I mean, we thought we were going to have a big opportunity to buy distressed hotels. We were kind of excited about all of this in the pandemic, and things came back so fast we didn't even get a chance. So actually, hotels are doing better than we would have thought. Retail, I think, has been well told. That is a difficult story, but that does leave the elephant in the room, which is office. And office, our head of real estate that likes to say, offices can be divided into three things. There are real winners, which are mostly new offices that have been built since 2016 in prime locations. And it is amazing what new rents some of these owners are being able to get. There is a whole group that is kind of in purgatory, which is about 60% of the buildings which are not in good shape, have not been upgraded to either to climate standards or to kind of a hospitality that's wanted today. And there's 20% of the stock which is actually probably going to get the keys handed in on it. So we are going to have a big workout for that purgatory set over the next 24 months. Prices will come down. Some of that will get reinvested and rebuilt, and others of it will have to be repurposed. So I think there is a true reset in value in real estate, and now is a great time to be with an active manager in real estate and not buying the index, for sure.
And if I can just add to that, we sort of see the same trend. We have most of our exposure through our partner Amherst, who really have exposure actually to the one attractive area that David just mentioned, which is the multifamily space, where they manage something like 50,000 units. And if you think about what's happening in the office world and the multifamily sector, they're sort of pulling in opposite directions, but it's all triggered by COVID, right? The occupancy in offices has dropped, which is impacting the value of office real estate, but at the same time, people are spending more time at home, and therefore they actually want larger homes. So, and that's all very positive, and it's creating fantastic opportunities. The refinancing opportunity will also create fantastic buying opportunities for those that have cash at the ready.
Right. David, I do want to come back to your earlier remarks on private equity and your concerns there. Can you elaborate a little bit on that?
Well, I think that it's no secret that a lot of the attractiveness of private equity over the last decade has been low rates and the ability to finance a lot of these companies at very low, and in some cases almost negative rates. Now, with much higher rates, that becomes a harder trick. Now, many private equity firms have managed themselves with relatively low levels of leverage and have focused much more on operational excellence of the companies that they buy, and I think that will carry on to be just fine. So I'm not calling for somehow a great decline in the returns in private equity, but I do think there are a variety of new players, and it's amazing how many new players have come into private equity who I think haven't had the experience of operations, who have been relying on a lot of leverage. As that stuff comes due, I think that's going to be very hard, and I think those marks will start to come through in the next year on those books, for sure.
Great. Hanneke, do you have thoughts on private equity?
No, not as much. No, I think David summarized it well.
Great. Well, then I will, as promised, come back to AI then, which I know we have heard lots of different viewpoints on it today. Some people think it's, or the hype is getting ahead of the reality of the technology. Other people think it's potentially as transformative of the internet as the internet. Yeah. Where do you stand?
So AI is already meaning so many things, right? As you say, on one level, it can be hyperbole and it can indicate froth in the markets. To some extent, it brought me back to sort of the late 90s, right? When we were all talking about the internet, and actually where you were making money was in the picks and shovels, but not like selling eyeballs. And the other analogy that it brought back in my head was every time I would come here, it was, of course, you always knew there was real froth in the market when you were a yellow cab driver at the time, not your Uber driver that we have today, would ask you about which internet company to invest in. So I haven't been asked yet by an Uber driver what AI stock
It will happen soon.
I would be investing in. But so I think there's real opportunity to be had actually in the equivalent of picks and shovels, as we're already seeing in really the advance of certain companies. NVIDIA comes to mind, for example, in the AI space. But what is really, I think, the interesting story is how we are using AI in our own environments, right? Both as an investment theme, but also how we use it in our business. At BNY Mellon, we have actually at the broader enterprise level established a digital R&D hub in Dublin to look at how we can look at document automation and analysis, or how we can use predictive analytics, all for internal use, but also for our clients. We're looking at how we can use natural language processing as an aid into the investment research process. So it covers multiple strands. I don't think we're at a time yet where it will replace the human in the investment process, but it can certainly augment.
I think it actually has the potential to make a lot of the jobs fundamentally more interesting. I mean, we absolutely have what we call kind of sandbox experiments, because we still want to be very careful. You know, we don't want to train a large language model on our data to find that it all of a sudden sort of escapes out the back door, right? So we're very careful and very kind of controlled about how we use it. But nevertheless, the ability to take rote tasks, of which we have many in the asset management business, and really automate that extremely quickly, and therefore turn the job of the credit analyst into much more one of problem solving and analysis instead of spreadsheeting, I think is really exciting. And so I'm not one of these people that thinks there'll be many, many less jobs, but I do think, at least for our industry, it will be the jobs that we have will have kind of moved up and be more interesting than they are now. And I think that's very exciting. So we're actively experimenting with it, and I expect it'll be more and more a part of our business as we go forward.
Right. Well, I am afraid that we're going to have to leave it there as we're out of time. I feel like I could ask you each so many more questions, but thank you so much for that.
Well, thank you for having us.
Appreciate it.
Great to be here.
Please welcome to the stage Bridgewater founder Ray Dalio with Bloomberg's David Weston.
Okay, here we are with Ray Dalio, the one and only.
Hi, David.
Hi, it's great to have you, Ray. Thanks for
Great to
doing
be
this.
here.
Always enjoy speaking with you. So we all know Ray Dalio, obviously, is the founder of Bridgewater and is an esteemed author of books as well as LinkedIn posts that we all wait for. But he also now is starting something actually with Masterclass as the number one luminary investor. So congratulations.
That's how they pitch it.
Is it? Well, I think we'd all agree with that. So we have read your material, and we have some sense of how you structure it, particularly in your most recent book. You've got 5 basic forces that explain a lot of economic history. You go back several hundred years and look at it. And I thought we might take some of those and apply them to the present day. And as I recall them, and you'll correct me, the first one has to do with money, credit, debt, the economy, right? And then internal conflicts within a country, external, and then forces of nature, which would be climate change probably today, and then technology. Start with the first one, the one that involves debt, credit, money, the economy, and apply it to the here and now. One of the big raging questions is, are long-term interest rates, and for this purpose I guess I mean really real interest rates, are they going to remain elevated? We're down at negative, we're now up above 1. Are they going to remain elevated in the out years as you see it, or do you think they'll come back down? There are camps in both directions at this point, and you look at the long term. Long term, where are we headed?
Well, it's most important to me to not just answer questions like higher, lower, or whatever, but to try to explain the mechanics, the cause-effect relationships that are going on, right? And the reason I did this study, which then turned into a book, and I'm just a practical markets decision maker, is that 3 big things are happening in our lifetimes that never happened before. Let me say that again. 3 things that surprise us that haven't happened in our lifetimes, but happened many times through history, are the creation of an enormous amount of debt and debt monetization. The second is the internal conflict, the large wealth gaps and the internal conflict that makes the politics of populism and so on. And the third is the great power conflict, comparable powers, the United States and China, and the possibilities of war. But back to your question in terms of the mechanics, there are very basic, simple things. That there is a debt cycle. There are short debt cycles. We're used to those. They last on average about 7 years, give or take about 3. And you have recession, and interest rates are low, inflation is low, and the Federal Reserve becomes stimulative, and then you have growth. You have non-inflationary growth, and you have inflationary growth, and they tighten monetary policy, and then you have the slow up or the recession that follows until the cycle participates. It happens that way. We've had 12 of those. We're in the 13th. We're about halfway through that cycle. We're at the point where interest rates have to rise. Okay, so the level of interest rates, you have to satisfy a debtor and a creditor. And so that means interest rates have to be high enough that the creditor gets a real return, higher than their money. And if you don't do that, you create the cycle that we have before, where money is essentially free, interest rates are nil, or in some cases negative, and you have a situation where you don't have to pay principal, so money was essentially free. Then that imbalance is enormous, and it's made more enormous because even then the supply-demand is not adequate. There's not enough demand to buy those bonds. And so the Federal Reserve's got to come in there and print money and buy those bonds and redistribute wealth. So you have that. So now we have moved to a level of real interest rates. Think about inflation. That is, depending on how you calculate, if you look at tips or if you look at short-term interest rates, they need a 1 to 1.5% real rate. Those days that we have seen in the past are over, and there's a big adjustment in that. So the headline for that is, so who have been the losers? Who have been the winners and who have been the losers? This is a different kind of debt problem in that what happened is, in order to create this big transfer of wealth that there needed to be in various ways, the government borrowed a lot of money because they spent a lot more than they earned, and they sell a lot of bonds. And then the Federal Reserve buys bonds, and it subsidizes those bonds. And so the big losers of this cycle has not been the individual balance sheets, because the individual balance sheets have been improved. It is the fact that those who are holding government debt are the ones that are having the losses. So the central banks have all lost a lot of money. The commercial banks bought a lot of these debts. So when we look at the commercial banking problem, it is largely a government debt problem because there was the financing of holding bonds with short-term interest rates, and so that was the squeeze. So you have that particular dynamic. As we move forward, the higher you raise the debt-to-income ratio, the more difficult that balancing act becomes. And so we're seeing a trade-off now that interest rates have got to be high enough for the creditor, but not too high for the debtor. And so you're seeing now this adjustment in which you're having sort of a 1%-ish growth rate, not the household sector having a problem, but those who are holding the bonds and so on, they're having the problems. And so you're seeing growth come down with still an inflation issue. The inflation issue comes from two parts, really. First of all, if you spend a lot more than you earn and you give a lot of money in credit, you're going to have an inflation. But it also comes from the supply-demand of bonds. So if you look at who's benefiting in this, the household sector, the workers, are benefiting. This isn't a classic recession in which the unemployment rate goes up, because the unemployment rate is remaining relatively good because there's wealth transfer, and you have, and they are also having higher wage gauges. And then you have the inefficiency of the global supply chains, which happens there. So what that means, I think, is that you have this stubbornly high inflation. We're not going to go down to our targets for a number of reasons. And then there has to be the real interest rates remaining high in that. And that creates a sort of stagflation kind of environment.
So let's talk about that stubbornly high inflation. There are some who think that there are larger forces that may drive it back down. Demographics in particular, too much savings actually globally as the population ages. At the same time, reduction in productivity, less demand coming online. Some people argue, in fact, that we will have the inflation come back down on its own, and therefore the nominal rates, if you add your 1 to 1.5% on top of it for the real interest, they will come down. Do you disagree with that?
Yes. It's a matter of the amount of money and credit created, and it's also a matter of productivity. And so when we look at the amount of money and credit, we will spend a lot more than we will earn. We know the budgets, we know the projections, we know individuals. The big risk there is a supply-demand risk. So we are going to sell a lot of bonds, and then the question is, does the Federal Reserve come in and then start to print and make that? So I think from the demand, including employment and the amount of money creation, we have that power. And then we're also living in a different world, particularly as supply chains change. The only big question is the technology impact. Like if we take a 5-year, you were talking about a longer term horizon, we'll have to talk about technology and the impact that that'll have on that in terms of productivity. But the demographics is not a favorable thing because what we're going to have to do is draw down savings, and there's going to be lesser number of population. So in terms of the labor component, I don't see that as a net positive.
You mentioned that going out, it looks like we're going to be borrowing more than we're earning. Does that mean we are in or headed for a debt crisis? You wrote a book on that as well, studying debt crises since 1945. Are we in a debt crisis or are we headed for one?
We are in my opinion, we are at the beginning of a very classic late big cycle debt crisis when the supply-demand gap, when you're producing too much debt and you have also a shortage of buyers. What's happening now as we have to sell all this debt is we then do have enough buyers. There are changes now in terms of the quantities in the world that are being held by large investors around the world that have lost money in these treasury bonds and so on. And then there are geopolitical changes which are having an effect. Some cases, some countries are worried about sanctions, and then there's this geopolitical shift. So when I look at the supply-demand issue, there's a supply-demand issue for that debt. There's a lot of debt. It has to be bought, has to have a high enough interest rate. So a crisis, that's, if we continue down this path in terms of what's likely over the next, 5 and 10 years, then you reach the point that balancing act becomes very difficult.
How will we know? And is it really a function of not having enough buyers for the federal debt? Is there any evidence of that so far?
We're right at the brink of starting to find out that. The amount of selling of government debt collapsed, right? We didn't issue government debt. And now we're going to issue a lot of government debt. And so when we look at the buyers, there appears to be a significant shortage of the buyers for that government debt. But we're now at the brink of being able to see what that supply-demand picture looks like as we go over the next year and two.
Given the challenges that we face, fiscal challenges that you describe, we need a political process that will help us get out of it. Do we have that? It goes to the second issue that you always deal with, which is internal conflict.
Well, the things that you see happen over and over again when you look at history is when you have a financial not good situation, at the same time as you have large wealth gaps, you start to see the emergence of populism, and we see extremism in both of the political parties. Okay, we see that split. A populist is an individual or a leader or a political person who will win at all cost, that the rules of the game don't as much matter. And so we're in the January 6th type of incident and so on is very interesting. The political system in terms of primaries and the parties tends to create that sort of polarity. I think that I think it's very clear that there is only one good outcome, if we can, and that's a strong bipartisan middle, because either of the extremes is not going to be able to be dominant. The small right, or even the small left, and as a result, we're seeing a fragmentation. Geographically, you're seeing people move to different areas, not just because of taxes, but of differences in values and so on. And so you're seeing this separation. I think over the next 2 years, the real question is, can we have a strong bipartisan middle, or are we going to have that kind of fragmentation? We have three things aligning that are concerning. On this short-term debt cycle, I call it, the 7-year cycle, we're about halfway through. In other words, interest rates are now at a level that they're probably going to stay at, but they're probably not going to rise much from here, and there's tightness. And the consequences of that are going to be a weaker economy going forward. It doesn't have to be a big downturn because of the household sector, but it is a balance sheet kind of recession. And I think things are going to get worse in the economy. There's a financial issue at the same time as you have this internal conflict. So I think that that's going to make for a risky situation, particularly then when we deal with the third major influence, which is this conflict, this geopolitical conflict in the world, particularly related to China, Russia, and the implications that has on supply chains, production, and the like.
Well, let's go exactly there, because you know China very well. You've spent a lot of time there. You've invested there over the years. What do you make of the situation with the U.S. and China? You said some things that we really think we're heading in a bad direction right now.
Right now, there are irreconcilable differences on a number of topics. Taiwan, Russia, reverse CFIUS, chips, and so on. They're kind of at the edge. And that there's an inability to talk. So there's quite a bit of brinksmanship. And we are also heading into a political year here in which there's going to be more pressure. Both sides are very worried about this. So I think you're going to see restraint. I don't think it's going to lead to a terrible situation in terms of, but it is leading, but you're going to see restraint in a period of time where you're going to see more tensions. There's the Mike Gallagher's commission and so on, more pressure with chips and so on and so forth. I don't think that that's going to cross the line, but it is going to raise tensions. You will see also more attempts, Tony Blinken's going over, you'll see more attempts to try to smooth things out because both sides are afraid of where we are. In any case, while it'll be that kind of brinksmanship, most likely there's a building of self-sufficiency. In other words, efficiency was the game before. Everything was global. You produce it in wherever the cheapest place was, most cost effective, and we became very intertwined with each other. Now in this global world, there's the worry about being cut off in all sorts of things. And so you're having that dynamic play, a negative role in economics and inflation.
In thinking about the U.S. relationship with China, which I think is probably the most important geopolitical economic relationship for the next generation, I would venture to say, many people have made much of the fact that China is going to overtake the United States in terms of the size of its economy, the strength of its economy. There are some questions about that now. Where are you on that question? And if, in fact, China is not as strong as we have thought it is, economically I'm talking about now, how does that affect the relationship?
I think it's almost like splitting hairs. There are two great powers, and the difference of overtake. If you take purchasing power parity, the size of GDP, they have slightly overtaken us. If you take the other, who knows? The main thing is they're comparable powers. in many ways, having strengths. They can do a lot of, they have a lot of dependency with each other, and they can do a lot of harm. So the most important thing, I think, is how we take care of ourselves. Can we get strong? Can we raise productivity? Can we be politically and economically cohesive so that we can be effective and strong? Because, you know, you can't rule out China. Since I started to go to China, 1984, per capita income increased by 28 times. It's a power, and it's a smart power. So it's going to be like that. No, there's not a winner or a loser. There are only either you're going to have both winners or you're going to have both losers.
What is the route for the United States to come to a functioning relationship economically with China? Because that seems to be what people are grasping for. I mean, you could say going back to 2000 and the WTO, that was part of the theory, that China would become more like the United States, more like the West. That didn't quite work out that way. And now I think we're not quite sure how to deal with them. What is the way to have a relationship that we're going to have different systems? We're not going to agree on everything by any means, but we can really work with each other in a constructive way for the globe.
Fear. I have a saying, if you worry, you don't have to worry. And if you don't worry, you need to worry. Because if you worry, you will make sure that the thing you're worrying about doesn't happen. And right now, they're at the brink. And so the understanding of where the red lines are, and just like the Soviet Union, mutually assured destruction was the means by which we got through that. That notion of pushing each other will be just do not cross certain red lines. You know, chips are oil. In World War II, the United States shut off, embargoed Japanese oil, and they froze their assets, sanctions their bonds. It could be very analogous with chips and with bonds. There's worried about sanctions. Those kinds of there's a limit to being strong, and then there's that issue. So I think restraint on both parties is going to be of paramount importance.
One of the things that people hope for, I would say, is some cooperation, fundamental cooperation between China and the United States when it comes to climate, to try to deal with climate issues. Your fourth element, as I recall, was acts of nature and climate. What can we do with China? And by the way, going back to your point, that first we have to start with our being strong, what we should be doing on our own about climate.
There'll be probably, I would expect, some superficial cosmetic attempts at cooperation on climate. The other more contentious issues will remain simultaneously. And yes, the climate issue was very interesting. When I did this study, motivated by the first three of the last 500 years, I saw that acts of nature, droughts, floods, and pandemics, toppled more civilizations, caused more deaths than any of the things I mentioned before. And so climate is certainly an issue, and we're going to see, it's not like we're going to have great surprises, though great technologies are coming, but the worst is still ahead of us. I think you know enough about that to say that this is not an easy or inexpensive problem to handle. Fortunately, there have been great advances in many sorts of technology, but it's a long and expensive way to go.
It would not be easy or inexpensive if we all agreed on how to handle it. To some extent, this gets me back to your second issue, which is internal conflict. Because right now we see, for example, how many, 17 states, something like that, are adopting legislation to restrict their pension plans for making investments based on ESG. Can we address climate as a nation? Put aside China and the rest of the world. Can we address it as a nation when we have that kind of division, political division, over even addressing the question of climate?
Right. I mean, I'm not optimistic, particularly because it's also very expensive. And so what do you do when there's so many expenses? There's the climate issue. There's the social issues, education, poverty, and school districts. My wife works in some of the, to help out in some of the worst school districts. I'll give you an example. In Connecticut, which is always 1, 2, or 3 richest states in the country, 22% of the high school students are either dropped out of high school or have absentee rates of greater than 25% and are failing classes. And there's poverty in all these. So we have so many necessities, expenditures, and problems that we cannot agree on how to handle those problems. So there's a climate component to it, but there's a bigger, more fundamental component, which is why, I'm curious, and I hope that we will see a strong bipartisan middle beat the extremes in the political situation, because it is difficult.
Let's try to end on a hopeful note here and get to your 5th issue, which is technology or invention. You mentioned it earlier. You founded Bridgewater, and for everything I've read about Bridgewater, you put a great emphasis on the systems involved, the mechanics involved, the engine. It seems to me, without knowing about it, having done this for 25 years or so, that AI might apply to that fairly easily. Is that your sense? Where are we going with artificial intelligence?
Yeah, I'm so excited because, as you say, for 25 years, I would always write down my investment principles, all my principles, and then I would convert them to algorithms, which became decision rules, which became systems, and everything would run, and they would, like setting up a computer chess game, it would play, I would play next to it, and we would then reconcile differences and we would learn together. Now what's happening with generative AI is that one can take all of that knowledge and have it there, and then go beyond that, to have it as a partner, a thought partner, because the intelligence has capacities that the human mind doesn't have. We don't, the ability to process so much and everything at the same time. So I'm extremely excited. I think that this is the greatest revolution, bigger than the internet revolution. But like technology, it really depends. The problem isn't with the technology. The problem is with the people who use the technology. Will that technology be used to raise humanity's living standards, or will that be used for war, in a sense, for hurting each other? And so, but any way we're going to cut it, if you take those 5, we're going to go through a time warp. If we take the next 5 to 10 years, in the next 5 to 10 years, it's like going to go through a time warp. We're going to come out the other side, and you're going to see a very completely different world.
I'm going to take that as hopeful. Okay, Ray Dalio, thank you so much. He's a luminary investor, but also he's the founder of Bridgewater.
Yeah, thank you. Thanks a lot.
Taking an active approach to investing means looking at asset management through a different lens, one with a clear focus on our clients. Throughout market cycles, teams of specialists at Principal Asset Management have applied local insights and global perspectives to optimize results. This clear point of view allows us to identify the most compelling opportunities now, while positioning for what's next. Principal Asset Management, actively invested.
Please welcome to the stage Principal Asset Management Chief Global Strategist Seema Shah with Bloomberg's Emily Gallagher.
Hello, good afternoon, everyone. I'm Emily Gallagher. I'm our Global Head of FX, Commodities, and Economics product here at Bloomberg. And I'm thrilled to be joined here by Seema Shah, who is the Chief Global Strategist of Principal Asset Management. So welcome.
Thank you very much for having me here.
So today will be the sponsor spotlight. We're going to be talking about investment trends shaping asset management today. And the investment management industry has been through a ton of significant changes recently. And I'm curious, what types of trends are you watching, and how do you think asset managers are adjusting?
Well, I think in terms of from a macro perspective, firstly, because I think that it feeds into how asset managers have to think through things. The first thing is we've had this wonderful 10 years of easy monetary policy, we've had high returns and low volatility. Well, unfortunately, it looks like that is firmly behind us. So now you're moving into a time where inflation is going to be a bit higher. We think QE is behind us. The central banks are going to be having higher interest rates. So this really means lower returns, higher volatility. In the last 10 years, central banks have essentially done the work for investors. Right? They've made it very easy to make strong returns. But now, when you have an investment landscape which is more challenging with high volatility, we need to be a little bit better at our jobs. Right? We need to be a little bit more analytical. One of the things that we need to do is, identify some secular challenges, secular changes, and figure out the asset classes that will give you that exposure. So one good example, of course, is what we've been talking about all day. It's AI. Well, AI, right? You can get exposure to that, but I mean, if you haven't got it now, do you want to be buying right now? No, but you have got other ways of getting exposure. So think about stuff like data centers, which are still riding the AI trend, but they've got better valuations. So there are ways of doing that, and that really takes active management. That takes a deeper analytical approach, looking beyond just your obvious asset classes, thinking about diversification. The other part of it is also thinking about public and privates, right? As I said, this is going to be a more difficult environment to make the returns. How are you going to get your returns? Well, you need to think a little bit more exotically. Think about looking outside of the US, but also think about private markets, which I think for the next 10 years is going to be where you're going to get a bit more of a bang for your buck.
Okay. And I meet with a lot of macro strategists in my role as looking after our economics product. And it seems like there's a consensus and there's a broad consensus that the US will be entering into a recession this year. I'm curious, what do you think some of the risks are that we're not talking about, we're not discussing, and how do investors brace for that volatility?
Well, okay, so the interesting thing is that you're right. So there is a lot of consensus about this US slowdown, and yet there's no conviction. So if you go to your Bloomberg terminals and you look at the economic forecast for the US, for example, you will see that there is absolutely no agreement in terms of timing, duration, and magnitude. There is absolutely no consensus. So on that, there is no conviction. Yep. Another good example is the forecast for Europe, which is really interesting. This is Europe. This is the one that has continuously disappointed. They've struggled to have really strong positive growth. And yet, if you go on your terminal, there is not one forecaster out there who has any negative quarters of growth next year. Right? So that, to me, is a bit of a risk on the horizon in terms of the things that people are not talking about. One of the other things that we see is with regards to the banking crisis. General consensus view that it has passed, the acute part of it is behind us, and we can now just start to think about the impact on lending. Well, when I think about it, I think, well, wow, there's been 3 banking failures. There's 770 regional banks or so in the US. Are you telling me that only 3 of them have mismanaged their duration? I don't know. That concerns me. So I think there's a lot of potential volatility out there, especially when there is consensus but no conviction. And again, this is really diversification and active management. You have to be very, very careful in this kind of environment.
So shifting gears a little bit from risk to opportunities, what are some of the new opportunities that you see for asset managers to capture growth globally, given the dynamic nature of what's happening in the industry, whether it's industry or macro transformations taking place?
Well, so I mean, if you think about it again globally, right? So we put together a valuation map for equities, for example, looking at what percentage of time have various markets been cheaper than they are today. And you look at it, and the thing that's quite interesting is generally everything is fairly green, right? There's been a rally, of course, to date, but historically, a lot of the markets are cheap relative to their history. There's one which isn't, which is the US, right? So yes, the US has got the AI trend. That is incredibly important. It's something that you cannot ignore. But there are greater opportunities, I think, outside of the US for now. One example is Brazil. It's rarely been cheaper than it is today. If you look to Japan, I mean, there's been a bit of a rally. It's lost a bit of its attractiveness. But there is still a vast difference between the US and Japan. Another example is, you can continue to see that with the macro environment, although we've had a complete synchronization of trends, I think, over the last 10 years, partly because of the central bank policy, Now you're seeing that change. So there is a desynchronization going on now. Sorry if I said synchronization before, now it's moving to desynchronization, where you have a number of the emerging market central banks in Asia already poised to start cutting rates if they're not already doing so. And the other thing is that in the US, when we start to think about interest rate hikes or potential interest rate hikes, it's concerning. It's a real worry. But if you think about it for Japan, well, that is great news. So to ignore the global opportunity set, I think, is a big mistake. We, at the moment, believe that parts of emerging markets, I'll give you an example, India continues to be very, very attractive within Latin America. Brazil is an obvious one because of valuations. The other part of this is in terms of looking out over a longer term scale. So I talked about secular drivers before. Well, one thing is, for emerging markets, yes, there are challenges. Yes, it's a volatile asset class. But if you're going to look out, if you can look out over beyond a 6-month horizon, well, then there's a lot of growing opportunities, the kind of the growing middle class. That was a conversation people were having 2 or 3 years ago. During COVID, people seem to have forgotten that, but it still continues to be the case. China is a worry for everyone today. If you're sitting here, and actually David Hunt made a really great point before, which is about having that home bias. Well, if you're sitting in the US or if you're sitting in London like I am, and you think about China, maybe your first image is like, wow, the reopening story has been really disappointing. You're not seeing the central bank introducing the stimulus that we may have expected. And yet, if you are in China and you're speaking to a lot of the analysts there, that they actually have a lot more of a considerably more constructive perspective. Their view is that actually, if you've been listening to President Xi for the last 3 years, he has been talking about this idea of moving away from a boom-bust cycle to something which is more stable, trying to move the economy away from leverage. So actually what they're building is a more stable economy, which maybe for the next 6 months could be disappointing, but actually over a 10-year horizon starts to look very attractive. And I keep giving examples, but this is probably one of my favorite ones, is we talked about the office sector in one of the earlier sessions, about office REITs really being destroyed. And it is, partly because, not just because of the banking crisis, but actually mainly so about this lack of return to office. Well, in London, it continues to be actually a bigger problem. So people really haven't returned to the office. In London, although it's coming back to a bit of activity, it still feels a little bit stagnant. So that suggests like it should be quite concerning. And maybe sitting in the US, it sounds like, well, why would you have exposure to London? Well, actually, the office REIT sector in London has already adjusted fairly significantly. So actually, this is a fairly attractive opportunity. So I think having that deeper analysis of global markets is important. At Principal, what we've done recently is combine our asset management business with the pensions business. So we now, with having that footprint in a lot of the emerging market countries and global developed markets, it gives you the opportunity to have that global investment perspective into local platforms and also put local products available for global investors. So there's a lot of opportunities out there. It's not just the US, maybe there's US exceptionalism, but you don't want to have all your eggs in one basket.
That's really useful. Thank you so much for those insights and joining me today for the Principal Asset Managers Spotlight, Sponsor Spotlight, where we discuss the investment trends. There will be a break now, I am told, a networking break. I am told that we'll be back in this room at around 3:25. So thank you so much.
Thank you.
But I hear sounds in my mind, brand new sounds in my mind. But honey, I'll be seeing you ever I go. But honey, I'll be seeing you down every road. I'm waiting for it, that green light. 'Cause honey, I'll come get my things, but I can't let go. I'm waiting for it, that green light. Oh honey, I'll come get my things, but I can't let go. I'm waiting for it, that green light. Yeah, honey, I'll come get my things, but
I've been sleeping on your porch. I'm still too scared to bust the lock on the door. So I brought out the back door, took off all these tight clothes, jumped into the water. So I brought out the back door, took off all these tight clothes, jumped into the jam, pump it up while your feet are stumping. And the jam is pumping. Look ahead, the crowd is jumping. Pump it up a little more, get the party going on the dance floor. See, cause that's where the party's at, and you find out if you do that. A place to stay. Get your booty on the floor tonight. Make my day. A place to stay. Get your booty on the floor tonight. Make my day. 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 Yo, pump up the jam, pump it up while your feet are stumping. And the jam is pumping. Look ahead, the crowd are jumping. Pump it up a little more, get the party going on the dance floor. See, cause that's where the party's at, and you find out if you do that. A place to stay. Get your booty on the floor tonight. Make my day. A place to stay. Get your booty on the floor tonight. Make my day. 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 Yo, pump up the jam, pump it up, pump it up. Yo, pump it, pump up the jam, pump it up, pump it up. Yo, pump it, pump up the jam, pump it up, pump it up. Yo, pump it, pump up the jam, pump it, pump it, pump it, pump it. Pump up the jam, pump up the jam, pump up the jam, pump it up, pump it, pump it, pump it, pump up the jam, pump up the jam, pump up the jam, pump it, pump it, pump it, pump it, pump it. Pump up the jam, pump it up while your feet are stumping. And the jam is pumping. Look ahead, the crowd is jumping. Pump it up a little more, get the party going on the dance floor. See, cause that's where the party's at, and you find out if you do that. A place to stay. Get your booty on the floor tonight. Make my day. A place to stay. Get your booty on the floor tonight. Make my day. A place to stay. Get your booty on the floor tonight. Make my day.
All my friends are heathens, take it slow. Wait for them to ask you who you know. Please don't make any sudden moves. You don't know the half of the abuse. All my friends are heathens, take it slow. Wait for them to ask you who you know. Please don't make any sudden moves. You don't know the
Ladies and gentlemen, please take your seats. The program will begin in 5 minutes.
one day, docked away. Just because we check the guns at the door doesn't mean our brains will change from hand grenades. You love another psychopath sitting next to you. You love another murderer sitting next to you. You think I'd get here sitting next to you. But after all I've said, please don't forget. All my friends are heathens, take it slow. Wait for them to ask you who you know. Please don't make any sudden moves. You don't know the half of the abuse. We don't deal with outsiders very well. They say newcomers have a certain smell. Yeah, trust issues not to mention. They say they can smell your intentions. You laughing on the freak show sitting next to you. You laugh some weird people sitting next to you. You think how did I get here sitting next to you? But after all I've said, please don't forget. All my friends are heathens, take it slow. Wait for them to ask you who you know. Please don't make any sudden moves.
Ladies and gentlemen, please take your seats. The program is about to begin.
Why'd you come? You knew you should have stayed. I tried to warn you just to stay away. And now they're outside ready to buzz. It looks like you might be one of us.
Fire in the disco. Fire in the Taco Bell. Fire in the disco. Fire in the gates of hell. Doesn't wanna know how we keep starting fires. It's my desire. It's my desire. It's my desire. Don't you wanna know how we keep starting fires?
Ladies and gentlemen, please take your seats. The program is about to begin.
Danger, high voltage, when we touch, when we kiss. Danger, danger, high voltage, when we cut, when we kiss, when we touch. Danger, danger, high voltage, when we touch, and when we kiss. Danger, danger, high voltage, when we touch, when we kiss, when we touch, when we kiss. Well, don't you wanna know how we keep starting fires? It's my desire. It's my desire. Don't you wanna know how we keep starting fires? It's my desire. It's my desire. Danger, danger. High voltage. When we touch.
Please welcome to the stage Bloomberg's Michelle Lynn.
It's not just so physical. I'm a top who won't get up so critical. So let's make things physical.
Hi again. I'm Michelle Lynn, Global Head of Data Science and Insight for the Bloomberg Media Organization. I hope everyone had a chance to get some coffee, stretch their legs, look at the city and the sepia tones. Very interesting. As we return from our networking breaks over the course of the summit, I have the wonderful opportunity of conducting a few polling questions that have been crafted by our participating sponsor, Southern Company. Southern Company is a leading energy provider serving 9 million residential and commercial customers across the Southeast and beyond through its family of companies. Before we hear from Brian Moynihan, Chairman and CEO of Bank of America, we want to hear from you. Whether you're virtual or in the room, we would love for you to participate in this little polling question. So please take out your phones, or maybe they're already out, and scan this QR code here. To access the poll, you could either scan the QR code or you could type in meet.ps/BloombergInvest into your browser. I'll give you a moment to do that. Thank you. Okay, now click on the polling icon on the bottom right of the screen. Everybody see it? Okay. So the question Southern Company would like to ask you is, where is your company or portfolio on the path to net zero emissions? Your options are: net zero business model has been achieved, committed to reaching net zero by 2030, committed to reaching net zero by 2050, or other or not sure. Please cast your vote now. Again, the question is, where is your company or portfolio on the path to net zero emissions? All right, let's take a look at the results. So 42%, 44 still, the results are still coming in. 44% are not sure. We have about a third, 32% are committed to reaching net zero by 2030. Over a quarter, 27% are committed to reaching net zero by 2050, and 6% net zero model has been achieved. Thank you for participating in this poll. Thank you to Southern Company for that great question, and enjoy the rest of today's programming.
Please welcome to the stage Bank of America Chairman and CEO Brian Moynihan with Bloomberg's David Weston.
So, Brian, thank you so much for being here.
It's great to be here. They must have been expecting some other people or something.
There's plenty of room if you want to invite some guests.
Okay.
2 or 3 weeks ago, we were talking about the debt ceiling. We don't have to talk about that anymore. But maybe we can talk about the aftermath of what we went through there in Washington. And specifically, one of the things that's been covered on Bloomberg and elsewhere is, obviously, the government coffers were drawn down pretty substantially as they came right up to that so-called X date. And now they've got to issue a lot of T-bills. I saw one estimate like $850 million by the end of the summer.
Billion. We wish it were a million.
Oh, billion, 850 billion, and maybe $1 trillion by the end of the year is what I saw. The speculation is that might draw liquidity out of the marketplace. Are you seeing that at Bank of America yet?
Yeah, it's too strong, because I think if you look, they've daily published their balances, and they moved up a chunk, and you guys covered this today, and because of tax payments coming in, and you get estimated tax payments, et cetera. But their policy has been, by their own design, to get to have $1 trillion of money running through this that they have at all given time, so they can fund to keep it level there. So they're going to have to push up and do that kind of funding level. You know, when I ask people, is this disruptive or not, all the experts tell me yes and no. And yes, in the hand, there's a lot of issuance, but no, everybody knew it was coming, and so it may move sort of trading markets around. But fundamentally, the idea that the government was going to run out of money was not something people were planning on. So we'll see. It's just another thing to worry about for the next 6 months.
Does it put any kind of a crimp in your ability to lend? I mean, that money has to come from somewhere.
Yeah. Well, there's a lot of money sitting at the Fed and the overnight repo facility and money funds that's just been put back. And so the dynamics of how this all moves around is interesting. I don't think, in the worry be it took deposits out of the banking system, but I'm not sure people see that as a big issue. And by the way, the Treasury Secretary, and I think they said today, they will do this on a non-disruptive basis, because they just ran down to $39 billion. We're still able to pay the bills. So they don't need to get there tomorrow, and they'll build it up over time. But their goal is to get back in a more regular way. The best news about this whole dialogue is they've got an agreement that extends a period of time, so we shouldn't have to deal with this for a while, which is really critical, because the United States has to be the beacon of stability, strength in the world. And at times when this discussion's going on and you travel the world, everybody gets fixated on it, because the United States is the benchmark of benchmarks, and if it goes kaplooey somehow accidentally, it's a real problem. And so they would get all fixated in all this sort of activity into planning for it, and what would happen in all our company. It would just be better if it didn't go on, but it's a political process, and they had it.
Well, beacon of stability, we didn't look much like that for a little while there, right? Do people forget about that after it's over, or are there lingering effects, do you think?
Well, I think that look, in my memory, in 2011, it felt more serious at the time than it did this time, because I think people had learned from the actual shutdown and some of the dynamics in the actual downgrade of the United States that you can't get that close. So I think the assurances of both political parties plus the experts involved always was, we're not going to let this, it may be messy, it's like a Greek tragedy, you always know what the end's going to be, but it's fun to see how they get there. But at the end of the day, they got there, and that's the important thing. But it's a political process. There's another serious question about how much debt the country can afford and all that stuff. None of that's embedded in this as much as it is, the issue of the moment was really getting the idea that somehow they would not be able to pay their bills or have to shut down and or default off the table, and that's what's done.
Perhaps a related issue, actually, are the reserves required of your bank and other banks. There are reports, and I don't think it's unexpected to anybody, that there's going to be an increase in capital requirements. If that goes forward, will it have any effect on your ability to make loans?
Yeah, so there are multiple discussions which get sort of pushed together. There's the standards for the finalization of Basel, which is this broad set of things. That's going on. The stress test is going on that we forget about, but that's going on also, and that resulted in some surprises in the industry in terms of capital demands last year. And then there's the question of applying standards that apply to the GSIB banks, the biggest banks broader in the platform because of the size of some of the banks. And so all three of those things get mixed together a little bit. But at the end of the day, it's a fairly straightforward. If our capital ratios go up by 100 basis points, we basically, simply put, can't make about $150 billion of loans. And because people say, well, you have more capital, you can make more loans. But if we took risk on that capital, we wouldn't have that capital ratio. So it has to be a riskless build of capital. Can't be out there taking risk. So the only thing you can really do is leave it in cash or buy treasury securities. And that's not a very productive use of money. So, and if you had it, and that's the problem. And so every time capital goes up, there's a countervailing effect to it. It impacts lending.
Is that a gating function here right now? Over the last couple of weeks, you've been saying that, in fact, some of your lending is slowing down anyway, just because the economy is slowing down. Is there demand enough for the loans that you can't make?
That ebbs and flows all the time. So the loan demand is more a product of customer activity. And so our team has a recession predicted beginning in the third quarter, fourth quarter, first quarter. Bank of America research team, which Candace Browning-Platt leads, is tremendous, and they have that. That has moved out a little bit as a consumer, and activity stayed stronger, even in light of the fastest Fed rate increase in a long time. And so, but it's still the prediction. And so I think companies, having gone through the inflation and then it sort of flattening out and thinking about the future, just being more careful because they realize that some are able to move prices, some are able to do it. They're getting relief on the commodity side, on the price side, but are they going to be able to hold price demands? Is final demand in the construction industry going to be as strong a year from now as it is today? And the housing, all this is on people's minds, so they tend to pull in. And so that means line usage is flattened back out. So line usage was here before the pandemic and then fell and moved up, and it was kind of moving up incrementally back to where the pandemic sort of flattened out for the last couple of months, which means that companies are just being a little more careful.
So I see actually a survey was done in this room of the likelihood of recession in Q1 of 2024, and it looks like, what is that, 65% of the people agree with your research. Isn't that good to know? You've got a ratification there.
Yeah, one thing we always have to be careful. Somebody educated me once that the forward projection of recession by economists is always like 15 or 20%. So anything above that means that they're convinced. So we'll see.
So let's talk about something that's very much in the news these days. That's artificial intelligence, particularly generative artificial intelligence, large language model. You and I have talked in the past about Erica, which is a form of, I think, machine learning you've been using for some years now, 5 years. We've never really talked about what that is. So take us through what Erica is for Bank of America right now, and then we can talk about where it's going.
So what Erica is a product, a capability that's in the mobile banking app and other that you can go into and either type in or say, pay my landscaper, pay my school tuition, whatever it is, and it will then say pay, and it'll say the name of the provider, how much you want to pay, and then it'll go pay it. And it'll just run it through the bill payment system. So instead of going to bill payment, going down the list and doing all that stuff, it do it. Or what's the routing number? What's my routing number? Because that's a topic that people call us and ask us about 5 million times a year. They used to call us. Now they don't have to. The routing number is on the base of your check, and routing number for all of you is the same. So it's not. But people call because, frankly, judging by the age of the people laughing, we were taught somewhere how to write a check and how the numbers worked and what was your account number. That's no longer in the system. So when somebody's doing ACH and stuff. So really like 7 or 8 years ago, we said, let's build something that can do that kind of language processing, the LP part of the thing, and then predict what the question was, use our data and our information, and come back with the answer to them. And so we started to do that, and the first thing we realized is the language that was out there for these natural language recognition type things was not written for banking. So what's my balance? Do you want to go to a yoga class? You know, think about it. So the first thing I had to do is we went to outside and got them to write a banking language program and things, and then we had to pair it with our data and our information. And so that's now 5 years old, and 20 million people use it, and they use it 150, 200 million times. We're just ready to cross 1 billion interactions with it. We'll get another billion in another 12 to 18 months. It's growing that fast. And it just saves a lot of time for the customer and client. And the experience is great. And yet people, I think, will start using even more now because they're playing around with ChatGPT and doing other things that this was sort of foreign to them. They were, what is Erica, like you asked. But what we've seen is it just continues to grow. And 20% interactions year over year, 30%, it just people going, because people like it, use it more and more and more. And it can answer queries. Now, what the flip side of this is, why have we deployed it when you hear all the worries you have about it? This is our data, this is our processing, this is our predictive language, artificial intelligence tool, the virtual assistant, feeding off of our Q&As and questions that we've edited to make sure they're right. So we don't have the problems that we're dealing with everybody's data and everybody's answers and everybody trying to figure out what is it perfectly going to apply. And so that controlled environment isn't the environment that these wonderful things are running on. At some point, they'll come together. In other words, why do we have a proprietary one when you can use it? But in between then is the ability to make sure your data doesn't get pulled into places that shouldn't be, making sure it works appropriately on your systems. And you're reading the articles in New York Times today and stuff, about in the healthcare industry, there's something written up, and all this, all these pluses and minuses, the legal case everybody's written about and all this stuff. Those are the risks. And even the people who really know this, tell you, this is 3 to 5 years of work to get those vagaries built a system. But we see it today. Now, you took that same stuff and you went and applied it to analyze who the best customers to call based on our data by people making inquiries to it for prospects in our business banking. And it was called Banker Assist, and that is out there operating every day. So a person has 100 prospects are looking at that in that line of business, and they can't call 100 all at once. So it tells them the best 10 based on who they cover, what they do, the kinds of industries they cover, the activity in the industry. Look, and these are 50 million under revenue companies. So this is not huge companies, and doing searches of the outside environment and talking about it. So we use it in other places already. It's got high potential. We got to make sure we maintain the appropriate customer experience, the appropriate control element around it to make it work.
We'll talk about the control specifically, because one way to expand it is just get more usage of it, which you're doing right now. Another way is to have it do more things. And we had a report actually on the Bloomberg this week about the CFPB, Consumer Financial Protection Bureau, coming out and warning banks, saying, watch this generative AI, banks, because it can make some mistakes. How do you make sure that you can use it the right way and you don't go too far?
Right. So that's the constraint on the openness of it, for lack of a better term, and by constraining it to our data and our information and editing and looking at the answers it gives and constantly making sure. But that's easier when you're saying it's our customer base, our data, our systems, our information, and our transactions. I'm not trying to assess the whole, everything out there, and that's a whole different question. But that's the lesson learned. But that environment doesn't do a lot of good for society. It does a lot of good for Bank of America customers and Bank of America. The question to make it good for society, it's got to have all of it in there, and that's the bridge from here to there is that question. So, the simple answer is we monitor that. We build it proprietarily, so it was built around our effectively the same thing a human would have done if asked the question, and then we convert that and then we back test it. You have to always look at it. We underwrite with automated and artificial intelligence and automated tools, but not in an open environment like this where the customer can keep at it. It's much more controlled as to how that works.
One of the hallmarks of your administration as CEO of Bank of America has been controlling the costs. You've been very adamant about that and very diligent about it throughout. What levers do you have at this point? Is AI a lever to help control costs, do you think?
Yeah, it will be, and it will be another. I always think of these things in arcs, so what could you do now that will pay back over time and keep paying back? And so if you started out big fundamental things we made, before people knew what the cloud was, we built an internal cloud. What that did is took all the server environments which were inefficiently disposed of, and that's the theory of a cloud, and pushed them together and said, you may want green servers, but you're going to take the blue ones because your software operate on them because you had somebody deciding that green ones are better than blue ones. So we pushed that in, and that did it. Then you went to the cloud, and then so these arcs of movement are just, so then you went to the cloud with parts of your stuff, and then questions, what can you do more? And each of that pays you back over and over again. And so, but the first answer was to go from 30 data centers to 5 or 6, and then down to 2 or 3, and then you have to have a certain amount of it. And that saved us, $400 or $500 million of run rate expense a year, to give you a sense. I mean, those are big moves. And then now the public cloud and et cetera. If you think about it, so you have to think about all the costs that way. So in real estate, we had 120 odd million square feet of real estate when the management team started in 2010. We're down to 60 to 65 or 70, and we still, with all the packing and stacking and work rules, even because of the pandemic, got to about 80%. So there was a lot of room to go. And now with all the work rules and stuff, you have a whole nother round to go. And so all that is, you just manage expenses by looking at all work that can go away, all inefficiency go away, and how you apply technology. And then you got to get the customers use it. So 70-odd% of people our age bracket and above use digital today. That number is growing, the fastest growing segment we have. It's not surprising that millennials and Gen Z and et cetera have a higher representation. But the reality is it's not getting everybody to use it, it's also getting everybody to use it fully. So even with younger people who use it a lot, still will deposit their checks at the branch. That difference is $5, 50 cents and a nickel, depending on branch, hand it to a teller, put it in an ATM or do another thing. And so there's a migration, even with people you think are using it, we still have $250 million will go out of the ATMs by tomorrow this time. I mean, it's amazing. So how do you get usage? So it's all those techniques just applied. And will AI help that? Yes, because we have 14,000 call agents. We have, where AI we think is near-term helpful is in computer development, program development. And that open source coding and analyzing, you still have to test it, but you can get it written faster, make it simple for people, and that we think has great applications sooner rather than later.
When we talk about costs, what about headcount? I know you said that it's not so much you're laying off as you're just not hiring as many as you were a year ago.
This goes back to economic, and I even talked to customers. So last May we hired 3,000 people. Excuse me. This May we hired 600, 700, and that's all because the turnover rate fell because last year we were in the middle of the Great Resignation, and now it's completely different. So we went from 12% turnover in the company, which is sort of the long-term level we were at pre-pandemic, down to 6, up to 15, and now back down, getting close to 6. So we don't have to hire as many people, yet we keep managing the headcount down. We just had 2,500 wonderful interns start this week, so that'll make us about, by the time we cross the quarter end, about 215, but you take them out, we'll be 213, 213 and a half or something like that, down from 216, 217 at year end, and we peaked about 219,000, not 209.
More broadly, do you think the job market is a bit softer than what the Fed realizes? Because a lot of their numbers are backward looking.
Yeah, I think if you talk to employers today in the technology space, there's always specialized things like welders in certain businesses and high-end manufacturing help, explosion in the Midwest, just having been out there. But in general, it's much less tight than it was in the spot market, and that's why the quit rates going down and all that stuff. You see it in the amount of hires, and so job postings are still high. I'm not sure CEOs that I talk to are pushing people to fill those as much as fill them when you have to, and that has a dampening effect on the labor market that won't show up in the aggregate numbers. Employment's still at 3.7% unemployment. It's still very strong, and so the big debate if you want to drive your economists crazy, say how can you have an unemployment-less recession? And they can't quite get there, and that's kind of the interesting question. And so even the highest predictors of unemployment don't even get to 5%, which is hard to square.
One last one, another hallmark for you has been responsible growth for Bank of America. From the day you took over, that's what you said you were pursuing. And you've also been fairly explicit about ESG investing and how that fits. There's been some political turmoil about that in the country now, with some of the states now, including some affecting Bank of America. How do you put together your desire for responsible growth on the one hand with taking into account things like environmental and social and governance?
Well, as we look out, the oldest part of the company has been around for 230 years now. They're almost in pushing beyond that. And so, our industry is a product of the communities it operates in. So we make it pretty simple. When we think of who we have to do a great job for, we have to do a great job for our customers. We have to do a great job for our teammates because we have to be the best place for teammates to work so we have the talent. We have to do a great job for our shareholders. We just had record operating profits in the first quarter. And we have to do a great job for our communities because, frankly, a bank reflects the economy. And so if the communities aren't strong, we're not going to be strong. So that's how we run the company. And responsible growth really talks about that a little differently, but that's how we run the company. And that's, but we have to, it's the genius of the and, profits and purpose, not one or the other. And Jim Collins wrote about that in 1996 as the theory behind, there's the thought process behind it. That's all good stuff. And the answer is sort of what's wrong with that? Thinking about how do I do a great job for my customers? How do I do a great job for my team? How do I do a great job for our shareholders? How do we do a great job for our communities? And that's, so, when you think about the energy and stuff, go out to North Dakota with Senator Kramer. We talked to the people. They got a net zero commitment at the state level and everything, and they got all this innovation to do carbon capture storage. Our job is to help lean into that and make that happen. Well, we have energy for everybody, and good, cheap energy for everybody, and energy for people in the global south that don't have this. These are interesting questions, but at the end of the day is private sector will drive this. And the money's there and the talent's there, and we got to drive it because in the end of the day, we can make it happen and have good growth and, frankly, from the United States perspective, dominate the place.
Brian, thank you so much. Always great to talk to you. Brian Moynihan, he's the chair and CEO of Bank of America.
Please welcome to the stage author, educator, and Bloomberg opinion contributor, Kyla Scanlon.
Hey everyone. Okay, let me make sure my slides are up here. Okay, cool. So hey everyone, today I'm going to talk about the Young Investor's Guide to Markets, but I want to talk a little bit more than just that. So today I want to talk about the difference between data and reality, storytelling, and hope. So if you don't know me, I'm Kyla. I work with Bloomberg Opinion. I've done some work with the Financial Times, New York Magazine, and my whole goal is to help humanize finance, to humanize the economy, and hopefully that's what we'll do in this presentation today. So the difference between data and reality, what is going on? I feel like that's a question that all of us have been asking recently. What is going on with markets? What's going on with the economy? And how can we make sense of everything that is happening? So when we think about the gap between data and reality, there's a gap between expectations, theory, and reality, right? Like we have this idea in our head, how we expect things to be, then there's a gap between how things are supposed to be, the theory of it, and then how things actually are. And I actually have a screenshot of a tweet because I think this tweet really encapsulates this idea well. Mario games teach us that even if something is essentially the same, psychologically it can be completely different. And when we think about the economy and we think about the stock market, that line there is really important. Things can feel the same, or things are the same, but psychologically they can feel completely different than each other. And when we look at things like survey data, right, so the jobs reports or different sentiment indicators, the data can be really volatile. And when we have volatile data, that can make markets more volatile, that can make emotions more volatile, and that can ultimately make policy like that the Federal Reserve sets and other central banks more volatile too. And I promise I'll tie together all these thoughts in a second. And there was a survey that was released pretty recently going back to that expectations, theory, and reality of the number of Americans who feel good about their finances versus the finances of the overall economy. So a lot of people, 73% of people, feel great about their own personal situation. But when they look around at the world around them, they're like, this kind of sucks. Everybody is doing pretty bad except for me. So people are feeling pretty good about their own situation, but bad about the situation that they exist in, the world that they exist in. And this is a pretty important delineation for how we think about policy, for how we think about the economy, and for how we think about the stock market. This is a quote from the debt ceiling, the debacle that we all just lived through for, I think, the 79th time. Because when we think about this gap between expectations, theory, and reality, a lot of times policy is really important play into that, right? And this person who I think was anonymous said that they're only measuring the success of the debt ceiling based on how much we lost. And so when we think about policy like that, when you're measuring success only on how much you lost, that's going to really impact how people feel about the economy, the stock market, et cetera. And then there's other metrics too. So going back to that idea of expectations, theory, and reality, the labor market disconnect, it's really difficult to track available jobs. It's really difficult to figure out what numbers make sense and what we should actually be looking at. And then there's companies fluffing numbers. So corporate America's earnings quality, the worst in 3 decades. And that goes back to that expectation. And I promise I'll tie it all together. Expectations, theory, and reality. Companies are, their numbers are saying one thing, and maybe the reality of how the stock is doing, how the company is actually doing is completely different. And of course, when we talk about companies and performance, we have to talk about inflation too. So this is a tweet from Nick, who is a reporter at the Wall Street Journal, talking about this underlying theory of inflation. Is inflation coming from companies price gouging? Is inflation coming from outsized consumer demand? It all ties back into that expectations, theory, and reality thesis. Corporations are people too. I think this is also an important line, this idea that a society in which it's easier to protect shareholder rights than civil rights, because going back to Nick's point, are corporations price gouging? Where is this inflation coming from? We have to have a big conversation about what it means to actually be like a person in the economy. And this is like an interesting line, because what does that mean? And then this, I think, is the final slide in this section, because when I feel like I've been sort of talking, obviously, about the expectations, theory, and reality, and a lot of that dives into narrative, right? A lot of that dives into the story that we're telling about the stock market, the story that we're telling about the economy, and whether that ties back into people's actual lived experiences. Because when we think about the narrative of the stock market, a lot of it is based on the idea of appearances, where we're molding reality to whatever narrative the stock market wants it to have that day. I'm sure we've all seen the headlines where it's like an oil rig blows up and the stock market goes up. And that's like a weird thing to read about, and it's a weird thing to feel. So this is the short-term garbage raccoonifications of markets, where we get really focused on the short term within markets, within the economy, that we often forget about the long term. We forget about what actually matters, right? And the short-term garbage raccoonification of markets is ultimately really net harmful, and can tie back to that idea of expectations, theory, and reality. So the data that we look at, so going back to the slides about the jobs report, inflation, et cetera, the data that we look at isn't always representative of the reality that we exist in. I'm sure all of us have seen that, even if it's just like the jobs report, where we have people on Twitter being like, the jobs report isn't real. There's a lot of ways to slice and dice the data that we see, and what's really important is how people feel about it and the expectations that they ultimately have about it as well. So this next part is going to be about storytelling. So the art of storytelling, and I promise this slide has a point too. I'm sure this is like what's it doing at a finance conference? But there's something in storytelling called ritual banality avoidance. And that's the idea that when you're writing a story, you don't make it really easy on the reader. Like, you don't just make 2 characters fall in love. You have to set the expectations for the reader as they're reading the story. So by the time the 2 characters do fall in love, they're like, oh, that I had to work for that. Like, I had to read through that. I had to not make assumptions. You have to create expectations as a writer that then your readers can follow. And markets are storytellers, right? Like, we all just lived through the debt ceiling debacle, where the debt limit breach begins to worry investors. But when you think about the debt limit itself, right, like the debt ceiling, for however you feel about it, it's ultimately a story. It's not something that necessarily needs to exist. It's creating expectations, it's creating this storyline, it's creating this narrative that ultimately we all have to prescribe to. And when you look at this is credit default swaps rate. That's a story. That's a storyline that the market is telling people about this debt limit breach and the worries that investors are having. And then I want to zoom out a little bit here. So we're talking about the markets, we're talking about the economy, and I think it's really important to zoom out to the meta level. What stories are we telling as a capital S society? So this is a tweet about the Super Mario Bros. Movie. It was like a huge, huge hit, but it was based in nostalgia, right? Like, it was based in this revision to the past. And when we as a society, capital S society, and when we get really stuck in that loop of always repeating the same exact stories in the same movies and doing the same things all the time, we have stagnation. It becomes really difficult to progress. And going back to that idea of expectations theory and reality, expectations become stagnant, and therefore we sort of become stagnant. So it's really important to tell good stories. Going back to the debt ceiling too, it's all super important to tell good stories about what we're doing. And the reason that Super Mario Bros. And the idea of nostalgia is so valuable is because our attention is really valuable. We're very expensive. Our eyeballs are very expensive. Ads are a big deal. And our eyeballs are commodities. And a lot of the things that we end up paying attention to ends up being monetized distraction, right? So when we think about nostalgia in Super Mario Bros., it's a lot easier to repeat those things rather than trying to come up with new and innovative things. This gets into the next aspect of hope and just storytelling in general, expectations theory and reality. There's doomerism. So when we think about our eyeballs being commodities, it's very, very profitable to tell people bad things, to make people afraid. Because if you're like, hey, the world's going to end, subscribe to my newsletter, people are going to do that. And there's this concept of doomerism that I think is just fascinating. I'm sure all of you have run into it, where people are telling you the world is going to end. It's this big combination of entertainment and brain stuff, right? Like our brains love being afraid. It's just how we're built. And then community, people are seeking out leaders. People are seeking out community. We're lonely on net. And then there's aspects of nihilism to that too. And in red on the screen, I have things that are bad, right? Like there are elements of doomerism that are completely warranted. But then on screen, I also have things that are in green that are good. So with doomerism, it's this really tough balance. And the important thing to remember with it is that our eyeballs are commodities, and people are trying to set certain expectations to get you to sort of manifest a certain reality. And then the biggest thing to combat doomerism and the negativity is to be optimistic, right? Like that sounds so silly and so easy, but it pays more, both in money and in life. And we owe it to ourselves and those around us to be optimistic, to be forward-looking, to be excited about all the cool things that we get to experience. And that is the easiest way to combat doomerism and to tell better stories. And of course, going back to the very first slide, expectations, theory, and reality, we are lonely, and we do tell stories that make us lonelier. This is a graph of media sentiment, and you can see that the news headlines that we're reading, I think this is very commonly known, are negative. And the thing that we can do to sort of combat all of this, right, like to combat the negativity and headlines, which are almost unavoidable. I mean, look at the sky outside, right? You have to be curious, and I think this article from The Defector is really good, where we have, billionaires who, it's really cool to go up into outer space, but there's also an element of curiosity that we can begin to encourage on a local level, allowing people to go after their passions, and that goes into the next thing, meaning. This was a piece in Harper's, The Age of the Crisis of Work, where meaning isn't always going to be attached to work, right? Like we have to be able to provide tools to people where they can find meaning outside of their workplace, because work from home, it's all changing, and I think there has to be a way that we allow people to be curious, to have meaning outside of traditional structures as it's always, quote unquote, been done. And then I think this is just an important thing too, this idea of words versus concepts, where a lot of people get confused about a word, they'll get angry at a headline, not maybe understand the underlying concept that is trying to be told, and then narrative, so going back to like just sort of tying everything together, because I know it sounds a little disparate, we have to tell better stories, because we ultimately are stories. Like humans have forever been sitting around campfires and telling each other stories. And so I think that's just an important thing to remember, is that the stories that we tell, the expectations that we set, the theories that we subscribe to end up driving the reality that we exist in, because we're all a part of the marketplace of ideas. Like this is, I think, super important to remember. Existing in the past is easier than engaging in the present. Nostalgia is going to drive us. We all love to have memories. But we have to remember that it's important to look forward. We've also commoditized ourselves a certain bit to the point where we are what we consume. And then I think this is important too. We've assetized our feelings to get them value on the sociological marketplace. And this is I'm going to skip this because I'm out of time. But this is, I think, the important thing to remember too, the hope function. So sort of tying together this, I guess, wide-ranging presentation, the idea of hope, right? Like that is the thing to combat doomerism. That is the thing to tie together expectations, theory, and reality. And I know that sounds like very naive, right? To be like, oh, we just need to have more hope. But I think the way that we think about hope is really important too, especially in context of markets, especially in context of the economy, the context of society at large, is that hope has to be future-facing, and we have to tell better stories about what we're looking towards. We have to be endlessly curious and encourage those around us to be curious as well, and realize that hope is defeatable. It's not going to be this perfect thing, and that is a-okay. But yeah. So this is also a quote I like. I really like quotes. If you read my newsletter, I have a bunch of them in there. So we cannot constrain anyone who is unwilling to follow the new direction of the question. We can only extend the field of the vision of the asker, loosen his prejudices, guide his gaze in a new direction. But all this can only be achieved only with his consent. So I think that's the other thing too, is community and realizing that you have to connect to those around you and be curious. But yeah, thank you.
Please welcome to the stage Earn Your Leisure CEOs Rashad Bilal and Troy Millings with Bloomberg's Caroline Hyde.
Welcome from your world tour. I mean, literally, these guys are on a world tour. Earn Your Leisure. I know that you now call it that. Earn Your Leisure.
Thank you for
all you who
pronouncing
have
it.
an American accent. It is always a joy to be with both of you. Thank you for making the time. First, let's just tell the story of how you've built a business around investing, because you are in the business of financial education. You're in the business of media content creators. You're in the business of live events, of children's education, of schools, of vending, of trucking. My goodness, you're diversified, if to say the least. So, Rashad, can you tell us a little bit about just the scale of people you have watching you? How are you interacting with people at the moment? You've got, what, more than 1 million on YouTube?
Yeah, 1.3 million on YouTube, 1.3 on Instagram. So I guess, the best way to describe what we have built as a community online of people that's interested in learning about business and financial literacy and investing, kind of democratized it, I think, and added a different feel to it, a different spill, but and been able to communicate and talk to a lot of great people in business at the highest level globally. So, when you look at our platform, started in the classroom here in New York, and now it's grown all over the world. Royal Albert Hall sold that out, and doing shows in Ghana and reaching different parts of the world is extremely humbling. But I think it speaks to the fact that for a very long time, the language of investing in business were only shared for a select few people, held at the top, and the vast majority of people were left out of the conversation. So now, the beauty with the internet and the beauty with technology is that it kind of has broken a lot of barriers. So we are a ladder for everybody, but especially people that have been disenfranchised and left out of the conversation for a very long period of time globally. So now they have a voice, and now they have an outlet that they can actually receive information from in real time.
And you marry investing with culture, ultimately with entertainment, and with highlighting other content creators. And Troy, you two are collaborators, always have been, went to school together. You were an independent financial advisor, teacher, came together realizing you could be the bigger of the sum of your parts from a global perspective. Whose voices are you raising, and to whom? Who are you, from the demographics of people who are logging into you, inspiring the most, do you think?
Yeah, I think we inspire numerous amounts of people. I mean, I think what's helped us as far as the collaboration part was realizing that we didn't know everything, and being humble students of a lot of different, asset classes. And so one of the things we found was that let's highlight people who are doing things that can help the everyday person, whether it's that your CPA, whether that's your accountant, whether it's your tax professional, whether it's your real estate broker. These people can help you right now, and they had a lot of value. And so rather than thinking we can only aspire to be a couple of things, let's make these people so valuable that they become superstars in their own right. And that's helped us along the way, right? And so when we had an opportunity to highlight these people, now they're giving information to us, but they're giving information to a whole community of people who never thought that they would find it. Because one of the things being inside the educational system, you realize these things aren't taught.
Yes.
Right? We didn't know how to buy a house when we left high school.
No.
Right? We didn't know what it was to pay taxes. We didn't even know what it was to fill out a resume. But all these things are valuable in our lives. And so when we had the opportunity to highlight these people and show value from them, then their economy grew. And by their economy growing, ours did as well, because people saw us as the platform that was highlighting the everyday person. And now that everyday person can be successful in their business as well.
With that sort of scale, though, millions of people consuming your content, comes great responsibility. And how, I mean, Rashad is someone who's studied finance, who understands the ways in which you know, things need to be factually accurate. How do you check that? How do you ensure that the people that you're highlighting, amplifying, don't get carried away with what ultimately was a meme stock frenzy, crypto scams, some of them?
Yeah, for sure. I think you have to be, you know, careful is the word I like to use. You know, I have a background in finance. He has a background in education. We didn't go to school for media. We don't know how to start a media company. We did it in real time, and we've grown tremendously fast. So we're still learning on the fly. So, but as you said, you know, when you have a large following, you do have a responsibility. So for us, it's a matter of, you know, using common sense a lot of the times as well, right? So we never pitched a get-rich-quick scheme. It's long-term wealth. It's about having discipline. It's about, you know, being patient. These are principles that we teach. It's not the most sexy as far as, you know, the headlines are concerned, but it's better to err on the side of caution as opposed to, you know, just go with whatever whims is flying on social media. So I think that we have done a good job of doing that and educating that and preaching that. And the people that we bring on kind of fit in that mold. And then, of course, you know, as our relationships have grown, it makes it a lot easier to have communication with Marc Cuban and Mike Nova grads and different people like that. You know, that obviously helps because you don't really need to vet. You know, we have Robert Smith on and different things of that nature. These are people that are already proven in their field. But we still like to give the up-and-coming entrepreneurs an opportunity to speak as well. We never want to shut the door to them because they're important. So these are the people that's really driving the economy, and these are the people that the general public needs to see because they have a better chance of becoming them than Marc Cuban. Even though Marc is a great guy, you know, the average person is not going to be Marc Cuban, but they can be, you know, a restaurateur, they can be a CPA, they can be a real estate investor. So I think it's important that we have a healthy balance of all of those kind of things, and the celebrities as well. You know, those are always beneficial conversations.
Well, to that point, Troy, like, it is sexy what you do. You were just saying it's not sexy, but when you've got Diddy on one side and you've got some, you know, Steve Harvey, the interview you do with him, I mean, he sat there with a great, beautiful cigar and backgrounds. And you know, how do you ensure that people see this as aspirational without ultimately losing their head about what is realistic and what should be seen as aspirational, what should be seen as actually real value? Because you guys have real moral values. And how do you ensure that the cult of celebrity doesn't sort of dumb that down in some way?
I think having that mixture, like you said, highlighting that everyday entrepreneur, which it becomes something that's attainable, right? Like I can follow these steps, I can follow these blueprints. I think for a long time, we've seen success in our communities, and we just kind of saw it happen, but we really didn't have the how to. And I think what we've done is we've created that ladder, right? So if there's a level of success that's up here, right, and the common focus here, who is that bridge in between to get the message across? And so what we were able to do is kind of create a language that people could understand and make it very digestible, very high complex topics. We're now explaining in a way that it could be understood, and not only understood, but people could execute on the information. We always live by the slogan, the information is going to be on us, the application is on you. And so when people trusted that the information was good and they used it and they applied it and they saw real returns from it, they came back for more. But not only did they not come back for more, they told a friend. And that's what it's about. That's how you build the community. It was like, okay, I have this information. Now what do I do with it? I did something with it. Let me give it to the next person, give it to the next person, give it to the next person. So when you're talking about scaling to 1.3 million, this is the pathway. And it's not from, hey, we got Steve Harvey. Because Steve Harvey's story is incredible. How many Steve Harveys are there, right? How many restaurateurs can there be? How many CPAs can there be, right? How many teachers can there be? How many people who create live events? How many people who create logistics companies can there be? There's a better percentage of them being in those careers, but first they have to see it, right? In order to be something, you kind of have to see it first. And so we put it forefront so everybody can see it, but they also have tangible steps to become it as well.
And I think it's also about, Earn Your Leisure is a luxury brand. So when we do things, it's curated completely different than anybody has ever seen in finance. So when we do an event at Art Basel, or we do an event at New York Fashion Week, or we sell out Royal Albert Hall, or we sell out Madison Square Garden, or we're doing events at South by Southwest, and it feels like a musical concert, and it's a vibe, and thousands of people are there. That's important because we want to shake up finance. I was a financial advisor for 12 years. I went to all these conferences, and the vast majority of them was boring. So,
no offense.
Yeah.
No offense taken.
No.
That side of the room didn't laugh.
Yeah.
Oh, he's laughing. Okay, go ahead.
Not the Bloomberg one.
We got it going on. We've got
the other ones. But, it's important that, we call it edutainment, a mix of education and entertainment.
Yes.
You can have fun at the same time. It's important to do it tastefully. We don't want to, water it down and make it like really too cheesy, commercial. But it was really important for us to kind of curate those moments where it just becomes like culturally important. That
Tell us about InvestFest, because that is the epitome of a cultural moment, right?
Yeah, for sure.
Yes.
So InvestFest, looking at the landscape, we're big music fans. So music festivals have become extremely popular, right? You got Coachella, you got a lot of these different musical festivals. And I really like the aspect of musical festivals, but it's just entertainment, that's it. So we were saying, well, what if we can take the best parts of a musical festival, but have a finance spin on it? So came up with InvestFest. So the idea of InvestFest is built just like a music festival. You got two different stages, a main stage, a smaller stage. We have a vendor marketplace, which is 400 small vendors and big companies there, and there's a DJ, and there's a podcast stage in there. Food trucks lined up outside. It's like a food truck village inside as well, where we have 20 food trucks. It's in Atlanta and Georgia World Congress Center. So the first year we started, we had 4,500 people. Last year we had 14,000 people. Steve Harvey, Tyler Perry, a few people, Don Peebles. This year, 20,000 people in Atlanta. So we have Diddy as the headliner. We have Robert Smith, but then Rich Paul, Mike Novogratz, Kathy Woods. So it was just a very unique vibe that we wanted to create, where it's a festival type of feel, but built around education and 3 days of learning, and just make it fun.
Yeah.
Just make it fun. So that was something that I don't think anybody really, still to this day, has kind of been able to top that. And that's an event. You're going to be there this year.
We got a special surprise here.
I cannot wait for the music element to meet the finance element, but the fun is important, right? And I don't have a magic poll with me, but I just want to get some audience participation. Who learned basic financial education at school? One. I mean, that says it all, right? Did anyone have you are an educator.
Yeah.
Why are you now, and I know you're both about to go to a school close to here, to think about sort of the ways in which people are learning. Why isn't it enough part of the standard education system? That's not always making it fun, but it's certainly making it necessary.
Yeah, I mean, it's an age-old question as to why it isn't. And rather than continuously ask the question, we said, let's come up with a solution.
Yeah.
Right? We can be the solution. And so, again, being inside of that system, you realize what is not being taught. And for me personally, it felt complicit. I'm being paid, and I know that these kids aren't going to have the things that they need to survive in the future. And so what was the best way to learn, right? I have to reach people where they're at. And one of the things I always tell people is, in order to teach a kid or teach anyone, they have to allow you to be taught, right? So how do I reach them? Well, I knew music was the great barrier. It's the language that everybody speaks.
Yes.
And so we listen to music and try to find pieces of music that I can teach financial lessons from. And so whether it was Beyonce saying, pay me in equity, let me reverse all the debt, there goes a lesson. Let's talk about equity. When Jay-Z was telling us, all we had was sports and entertainment, well, let's debunk that. This is now a hypothesis for me. How do we prove it's not? And that led into a lesson in teaching about the wealthiest people on the continent that come from Africa and come from our community. So it was like, all right, how many times can I do that? Over and over, I'm finding pieces of language inside of music that I can decode. And so that became the relatability. And once that became fun to learn, now kids are hearing music different. But now they're hearing finance different. And so that's when we talk about edutainment. Let's take where they're at. Let's take where everybody's at, music. Most people listen to that. Let's find the pieces inside where we can use and teach finance from it and make it something that's really, really entertaining.
I think the problem with the education system is that it's failing the vast majority of people. And we're all blessed. Even to be in this room is a blessing. Like, I was a financial advisor, so I used to be in these rooms all the time, but the vast majority of people are not being educated properly when it comes to finance on a variety of different things. So the problem with that is that it's not sustainable for the country. Because it's like, all right, if we keep neglecting 90% of the population, you're going to start to see a decline happen over the course of time. So either we address the problem or the society is going to suffer. Because the people at the top can do well, but if the vast majority of the people are not doing well, it's only a matter of time before that catches up with you.
But it's a global problem. I wasn't taught financial literacy at school, and you found that there's communities around the world that need to hear your message.
Yeah, I think you're exactly right, and that's part of the global expansion, right? We became popular here in America for teaching financial education and kind of democratizing it, but we've traveled around the world. We went to Kingston, Jamaica, right? My family's from there. Who's Earn Your Leisure there? It didn't exist. We went to Lagos, Nigeria, same thing. We went to Cairo, Egypt, same thing. We've been to the United Kingdom, and every time we go to places, they're saying, we're listening to what you guys have to say, and we're trying to implement it to what we have. But tax codes are different, laws are different.
Yeah.
So who becomes the satellite for those places that we travel? And we're looking at it like, you know what? This is an opportunity here, right? For the lack of education that has been presented for generations and generations, we now have an opportunity to change that for everybody.
Why isn't private sector getting it more? Why are finance events, maybe you haven't been to one for a while, maybe I haven't been to the right one for a while, but why aren't they cooler? Why aren't they meeting people where they are?
It's just a disconnect. The people aren't cool. So it's hard to have a cool event if you're not cool.
No, not this room. Not this room.
Respectfully.
We're here, so this has got to be cool.
Super cool. Super cool.
Super cool.
Sure. Are they, just give them benefit of the doubt, are they getting cooler? Like Novogratz, you've deemed cool, like admittedly he's on this like sort of avant-garde, on the
Mike's
on the circumference of finance with crypto.
But I think you also have to want to be cool, right? Like it's purposely done to reach a large.
But there's a market failure.
Well, you have to see opportunity in that market as well. So if you don't see the opportunity, then it's not even in your interest to even try to reach the opportunity. But being that nobody really tried to reach that group of people, that's an opportunity that we seized.
And we're starting to see it more, certainly social. We were just hearing from Kayla, we've got another financial influencer in the house. That certainly millennials, those slightly younger, are being targeted. We've got 1 minute left. I just want to do a quick fire on your What was your biggest money mistake, Troy, do you think?
Biggest money mistake, I was making, I think, $2,400 a month as a teacher assistant, and I wanted to get a new car, BMW 525, I'll never forget it. They probably had it as well. They were like, hey, payments are going to be $590 a month, and I'm thinking to myself, I'll make it $2,400. Okay, let's do it. And that turned out to be one of my biggest financial mistakes, but I had to learn from it, right? Like financing versus leasing, living within your means, all these lessons came from that. So it was, at the time, I thought it was a great decision. I've learned a lot from that based on managing money, like I said, and other issues.
Rashad, one money aspiration you've got, one thing you're excited about in terms of investing right now?
I'm most excited about investing.
Or building in your company.
Yeah, for sure. That's a good question. Education, I think, is important. So me educating myself, but also educating my son. And just watching his growth and watching.
So what one piece of advice would you have for your son right now in investing?
It's interesting because I don't really give him too much advice, but he just watches me. So I'm watching him talk to his cousin, and he's like, well, I own Tesla. And she's like, what are you talking about? You own Tesla? And he's like, I have stock in Tesla, so I'm an owner of Tesla. So it's, I didn't have that conversation when I was a kid.
Yeah.
So he's picking it, he's understanding it. So that's exciting for me to just see, like, him, he's not bragging about his clothes, he's bragging about owning stock. So what kid is really doing that? So I think that, me just kind of just learning myself and educating him at the same time, I feel like, that's something that I'm extremely excited about.
Guys, thanks for giving us a healthy dose of humble pie. We love it. We love what you're building. Thank you very much indeed. Troy Millings, Asha Bilal.
Please welcome to the stage J.P. Morgan's Global Head of Mergers and Acquisitions, Anu Aiyengar, and Freshfield's partner and co-head of U.S. Corporate and M&A, Ethan Klingsberg, with Bloomberg's Ed Hammond.
Hello, everybody. Anu, Ethan, thank you very much for joining me. I think I've done 4 or 5 of these kind of panels over the years at Bloomberg, and this is the first one where I can get up here and honestly say it's not a good M&A market. It's a tough time. It's a tough time to feel optimistic about it, but I think we're going to try and get to some of that in this discussion. But look, lots of things holding back M&A at the moment, lots of things that have proved to be quite significant headwinds for the last sort of 9 months to a year. Regulation is, for me, the most interesting piece of that. So, Anu, I'll start with you. We're in this environment now where you have a ton of regulation, a ton of fairly novel regulation that companies are grappling with as it relates to M&A. Are you seeing anything to make you feel that clients are getting better at navigating that or getting more comfortable with the environment as it stands?
Yeah, you're right. This is a tough market, so you need people with courage, and you need people with experience through cycles. Because that is what most clients are looking for, to say, this is a new environment, whether that is regulation or any aspect of it. And how is it that we deal with something that we don't know? How do we deal with the unknown? And that's a little bit of what the regulatory environment is dealing with the unknown. So it used to be that you would ask a law firm and they would come into the boardroom and you'd say, well, what are the chances of this deal getting approved? And now the approach is no longer that. It's a bit more saying, what makes strategic sense for us? We know that whatever is the path that you pursue will have regulatory hurdles. And so how is it that we prepare for that? So that itself is a shift in approach. And so how do you prepare? You got to think about, one, when you go knocking on the door of the counterparty, one of the questions they're going to ask is, how much work have you done? Why should I believe that you can get this deal to the finish line? And so if you're the one who's doing the knocking, then prepare. If you're one on the receiving end, know how to ask the right questions. And the next part of it is, how do you actually negotiate a contract with enough flexibility for you to run the company for the very long, unpredictable time period between signing and closing? How do you protect your franchise such that if the deal does not close, you don't have the empty shell of a company? And if you are a buyer, how much are you willing to litigate? Because the level of litigation, I'm sure Ethan will talk about it, has increased about 4 times. And so it's some of the traditional things we talked about, hell or high water, or there's a high enough break fee so that you feel good about that. Some of those are no longer enough.
Right.
And instead, what you need is real commitment from both parties to say, we're going to fight it, and we're going to play to win.
Ethan, from where you stand, is that the case, that companies are basically, as they go into transactions, assuming we are going to have to fight the FTC or we are going to have to fight the DOJ? And that being the case, what does it mean for the way they think about the deal? Does it change the price? Does it change the way they assume they're going to be able to absorb the asset?
You know, a couple of years ago, boards would have been quite
freaked out by the idea that all of a sudden you're telling them you have to litigate against maybe multiple governments in order to get the deal through. At this point, as Anu says, that's part of the game. If you're going to be in the M&A game and that's the way you're going to improve your company in a non-organic way, that's part of the playbook. And so I spend just as much time as an M&A lawyer with my antitrust litigators as I do with my merger clearance guys, who are the guys who file the documents. And often I'm sending the antitrust litigators to the meetings with the regulators as opposed to sending just the merger clearance folks. So yeah, that's a big part of the strategy now.
It's a brave new world where you have to show up to a pitch meeting with your antitrust litigators to convince companies that it's time to dance. But look, a big sort of part of the regulator's ambition here, at least when I think about the FTC and the CMA, similarly in the UK, is they want to stop people thinking about deals by actually having this chilling effect. And it seems to be working. I mean, isn't this exactly what they were supposed to do? They slow down M&A because they make people think, actually, we just can't be bothered with the fight.
Well, on the one hand, I think there's been the game has been upped on the side of the merging parties. It is true there's a number of deals that no one knows about because they're not happening. But when companies see a deal that really is going to be critical to their strategic rationale going forward, the game has been upped. And the idea, there's been a whole wave of deals I've worked on where we've done what we call fix it first. So we don't even wait for the suggestion. We just go in, sometimes even before we make a filing, and divest problematic assets. There's been a wave of situations where we coordinate with the way we're handling it with CMA, where we don't give timing agreements as much anymore. Because there used to be this thing where, you're talking to the agency and they say, well, just give us a timing agreement and extend the process out more, and maybe we'll reach an understanding on how to get this done. They've advertised, the heads of the antitrust heads at the US agencies have said, we're not interested in—
We don't want to understand.
We don't want a settlement. They don't want settlements. They think that they don't work. So why should we give timing agreements? So that, if you can do that, that goes to Anu's point. Once you get rid of timing agreements, you accelerate the time between signing and closing. And you can get right to the heart of it and get to an Article 3 judge, many of whom don't view antitrust laws the same ways as the current occupants of the US agencies. And then there's also, you have to play in Europe as well. And you have to play this whole triangulation of the Commission, CMA, and the US agencies off each other.
So when I think about regulation and indeed the other things that are sort of addling the M&A market generally, I think it's a perfect time for private equity. They have vast amounts of unspent capital. You have lower valuations, which obviously they talked about for years as being the thing they wanted to see before they came into the market. Yet we haven't seen the wave of LBOs I think a lot of us expected. And Anu, I'll ask you about it. Firstly, why is that? What are you hearing from private equity clients in terms of what's going to tip them over and get them into the market in a meaningful way?
Yeah. So the private equity, the dry powder available is more than $2 trillion. That's the amount of money available to deploy in buying assets. But what is it that you need? You need the availability of assets. You need the seller to have the right view on value. You need financing. You need to have a path to exit. And you need to have courage of conviction. And these 5 things are all shaky. So one, the assets that are proactively coming to market, not very high. I was talking to a bunch of private equity people at a roundtable, and each one was giving statistics of the number of deals that they have seen quarter by quarter. And this past 3 months is probably one of the lowest pipeline of deals proactively coming to them. So firstly, availability is not there. Second, value expectations, there continues to be a mismatch. You're talking about the public equity market valuations but give me a company who's happy with their stock price.
Right.
So you have to have a seller who is willing to sell at a price. So there continues to be a meaningful valuation mismatch, which sometimes can be bridged with creative structuring, but not always. Debt financing is more expensive, available for the deals that are happening, but yes, more expensive. That affects the calculus on valuation. When you think about exit, you have two challenges. How do you know what is the equity market valuation that you're going to exit at? And second, if you're thinking about a strategic deal, the regulatory environment, which we just talked about, the bar's gotten higher, right? So I can't bet on either option, or I'm putting a whole bunch of risk adjustment. And I'd say the biggest thing is courage of conviction. And there's just, we often say M&A is a confidence game as much as anything else. And so when people don't feel confident, they just do less M&A. That goes for public company boards as well as investment committees. So what needs to change for that to happen? I think the better assets coming to market, which we are beginning to see. Mm-hmm. Equity markets showing some robustness, and generally having a bit more certainty and confidence. So psychologically, I think the debt ceiling, getting through it helps. Having some clarity on interest rates, I think helps. So more number of uncertainty that you take out, you have more courage.
But Ethan, doesn't that drive it away from the private equity buyers? Because as those things start to line up again, we're going to see valuations go back up, which means it's going to be harder for the sponsors to play in certainly in the public markets. I mean, private market valuations are more sticky and so have come down less anyway. But yeah, it just seems interesting. Like, why wait? Why you have all this money to spend? You do have the availability of financing. I mean, the direct lenders are constantly telling me they're there and they have money and they want to do stuff. So it's
you have about a dozen guys or so who are contrarian and who are actually investing a lot. And I think these will be some of the best deals because this is a buyer's market. And I think if you're a strategic who has money or a sponsor who has money,
and conviction.
And if you don't do a deal in 23, I think you're going to kick yourself.
Yeah.
It is. I think one of the key ingredients where we're having trouble, though, is on the debt financing side, because that really is the special sauce of private equity, and that is expensive. If you're using the direct lenders, it's frankly exhausting. When we represented Coupa in the sale there, I mean, we had 23 direct lenders come together. They don't step up the way you do with 2 or 3 commercial banks. And it's hard, it's uncertain, you don't know that they're there till the end. And then you have things where there are a number of deals where we're having extraordinary equity checks being written. Like in the Qualtrics deal, $12.5 billion for all equity. So I think on the equity side, it's a little bit commoditized, but building out that rest of the capital structure, I think still has a lot of challenges, and it's expensive. If it becomes a little more certain, there's more banks involved, and the bond market can be available, the high yield bond market, then the banks will become more involved, and everything will start to flow a lot better, I believe. There's still a lot of companies that have had tremendous stock shifts in the last several months, and those guys are, as far as we know, the gap on valuation, I think time is not on their side. Right. And time is on the side of private equity, right? So those companies are ripe for sales. And a lot of them, the reason their stock price has gone down is simply they're spending a lot of money on R&D, a lot of money on marketing, and they're going to have to for the next 4 or 5 years. And then they'll get to a point where I think their margins will be able to expand. So that could be works very nicely for the private equity formula. I think we're going to see a lot more private equity take privates in the next 6 months based on those kind of companies that have nice cash flow, a lot of them software type companies that have nice cash flow and just need to get through a period before their margins are going to expand.
And a period that's probably better out of the glare of...
Yeah, better out of the glare.
Away from the activists. Yeah. The IPO market has obviously also been fairly challenged through this period. I wonder if there are sort of decent targets that companies can look at that are pre-IPO, maybe like to be out there in the public market, need some kind of financing, but just can't get there because there's just not the appetite.
I think those are all good hunting grounds for deals, right? So like I said, if you're a buyer, you should be looking at every place and trying to find negotiated deals. The company is about 400 plus companies went public in 2021, but are not fully exited, right? So you still have a controlling shareholder and the stock prices meaningfully. There's 300 plus de-SPAC transactions. Some of them are really good companies and are trading at a deep discount.
Some of them are bankrupt.
Yeah, some of them are.
A lot of them are not really good companies.
Yeah, companies which are waiting to IPO. And now you see, again, beginning of conversations in all these pockets. But still, I'd say largely domestic.
Right.
Cross-border is still very muted.
So one kind of transaction that was rife really through the last few years and does seem to still be happening is the corporate clarity deals, where you're seeing companies, instead of doing whole company transactions, spinning off a division, breaking themselves up into multiple divisions and being standalone in the public markets. Shareholders don't seem to like it. They didn't love it before. They still don't seem to love it now. I wonder why clients still see this as a sort of a useful thing to be doing with the business.
I think I'm not sure shareholders don't like it. I think the stock price of the company that announced the corporate clarity transaction has not re-rated up the same way it has in the past. So usually there is on average a 5% or so a share price increase. Sometimes it's a lot more than that. In the more recent time, you haven't seen that. But it's a hard thing to figure out because the entire market is down. Right. So if you had not done that, I mean, you can do a lot of corporate finance brain damage to try to figure out what the right answer is. But the driver of why a company thinks about it, because focus, having the right shareholder base for each part of your business, being able to use your currency for transaction, having the right equity research for that company, and separating higher growth businesses from lower growth businesses. Those theses still seem to hold. And another big driver of it is, frankly, I feel like we keep going back to your first question, regulation, is because you could take one of these pieces and maybe in 2021 or whatever, we'd have sold them.
Yep.
But now you're like, I'm going to spin it because I don't know how long it's going to...
2 years fighting regulators just to sell it.
Instead, at least I'll spend 2 years doing something where I control my own destiny.
Yep.
I mean, part of the problem is we're separating low growth from growth. A lot of the growth companies aren't getting much bang for their buck. And so it's not necessarily that there's not still logic in doing the separation. It's just it's not hyper logical like it used to be, because the difference in multiples is not as great. I think there's more excitement, and this is, I think, for the next half of the year, we're going to see more, I think, mergers of equals, where we have stock combinations, including cross-border, I think, because it's just, there's a logic to those deals where you have synergies. I think, you have to be thoughtful about regulatory.
I was going to say, synergies is a word regulators hate right now, because they say, well, then there must be a reason you're getting together because it's going to squeeze other competitors.
Yeah, but you could find some complementary ones. And also, as I said, you got to be ready to go to war from the get-go. And so those are deals, especially when you don't feel like there's a great runway over the next 7, 8, 10 months. Like, why don't we do something for the shareholders? So half the board may have to step down, and we don't know what's going to happen to management, but there are great ways to deliver value to shareholders. And I think there's been enough stagnation that there's going to be a push to do those kind of deals.
Because the big driver is still the need for scale.
Right.
Yeah.
Right? Because with that money, because, I don't know why synergies has become a bad word, because you do actually have to invest a ton in a company to address your supply chain concerns. Yeah. You have to invest to digitize at a pace that you never thought you would have to. Where is that going to come from? Right? It's not like cash flows and growth are gangbusters. And so the benefits of scale are there. So I completely agree with Ethan that I think the combination of equity markets where both the stock valuations are challenged, where debt is more expensive, I mean, this is a case study for why you should do MOEs.
Yes.
Right. Maybe we'll get some big ones in the second half of the year. So just before we end, I want to turn to activism, which, from where I sit, and maybe this is unfair, but it seems like it's gotten a little less interesting the last few months. Or activists look a little less smart when the market isn't going up and up and up. And I wonder, we're seeing some campaigns, not particularly novel ideas, but with some success nonetheless. And what are activists doing when they're getting on the boards of companies? What are they able to do that is in any way different from what the existing boards are doing as it relates to M&A, breakups, anything that, you know, is, as we've just been talking about, is challenging in this market?
I mean, when you're not at the mega caps, you know, their home run is to put the company in play, right? So they try and do that. Nobody wants to buy a company brokered by some activist hedge fund, but they're trying to put the company in play. Sometimes they have operational ideas. Almost always sometimes they're decent ideas, but the guys on the inside have such an informational advantage that they usually have already thought that through, and sometimes they're rowing in the same direction. A lot of times I have to get clients over the hump of saying, let's give the guy some credit. Who cares? It's the good idea that we were thinking about doing anyway. And then at the large caps, as we've seen, there's been this big push for cost cutting. Okay, brilliant idea, but that's really where the game is. So it's cost cutting, some operational ideas, which are usually not super well informed, and then I see trying to put companies in play who could be candidates for sales, especially a private equity. It's not. I don't think they're really. I think there's mostly. My clients are thinking like activists anyway for the last 5 years, and they're not waiting for the activists to get on the board to think this stuff through. And they're mostly there's been a whole sea change really on this. And so the 12 celebrity activists are not the only ones who have ideas about how to move these valuations up.
Yeah, I think they have twin things. Activism has become an asset class like many other asset managers with more than 100 billion plus AUM. So that has totally changed the dynamics of that. That whole asset class doesn't think similarly, doesn't act similarly, doesn't have the same motivations.
Right.
On the other side, the bigger change, I think, is the boards in corporate America have changed dramatically in the last decades. And so it is no longer easy because the boards are pretty smart.
Right.
And they're very actively engaged. There's real kind of check and balance at most places. And so I think the combination of the two is it's not that easy to make money as an activist.
Nice note to end on. Anu, Ethan, thank you so much for the conversation, and thank you everyone for listening. Thank you.
Please welcome to the stage CPP Investments President and CEO, John Graham, with Bloomberg's Matt Miller.
All right, I'm Matt Miller from Bloomberg TV and Bloomberg Radio. I've been looking forward to interviewing John for a couple of weeks now. And actually, John, you've proven to be a very popular guest. I've had so many people write in with questions and some comments. So hopefully I can do them justice today. We talked a couple of weeks ago on Bloomberg Television and BNN with my buddy John Ehrlichman. And you made news in that discussion because of your interest in emerging markets. You've been focused on that now for a couple of years. And not just in broader Asia, but particularly in China, India, and Brazil. And I asked you if that would change at all. It's become a very political issue, and your comment was that, no, you're there because you see a future in those investments and in that market. Tell us how important it is to you and what kind of size we're talking about.
Yeah, and we do continue to invest in emerging markets, and just for people's benefit, so CPP Investments is a pension plan based in Canada. We have around 570 billion of assets under management, and we made the decision years ago that it was important to be a global investor. That the Canadian economy is not that big, and we knew that we were going to have a sizable amount of capital to deploy, and we needed to build the relationships, the infrastructure to invest in the biggest economies in the world. Started out in the US and Europe and started to build our capabilities into the emerging markets and focusing on the bigger emerging markets, China, India, and Brazil, and some other Latin American countries. And built up now, I think, about 20% of the portfolio into emerging markets, which is where we're very comfortable where we are. But it's certainly gotten more complicated, and it's certainly gotten more complicated, and the world's changed over the past 5 years. And we do believe it's important to continue to invest in China. We have a 9% of the portfolio in China, and just have a view that as a global investor, we need to understand the world's second largest economy. We need to understand the role that the second largest economy has. And so we've kind of made the decision that we still need to be investing in China. But we spent a lot of time thinking about how to do it. And
well, we've seen others. British Columbia Investment Management said it was halting direct investments in China. Ontario Teachers Pension Plan cited regulatory changes in China for its decision to pause private asset deals in that country. So others, in Canada, not just American investors, are pulling out. What gives you the conviction to stay?
Yeah, and what gives us the conviction is that it is a big market. It does present interesting opportunities. We actually have a pretty good track record of investing in China. But I'll get back to the how. I mean, the how is really important. And we spend a tremendous amount of time thinking about how to do it. And that portfolio is really built asset by asset, thinking about what asset do we want exposure to, what company do we want exposure to, what sector do you want exposure to, and making sure we're comfortable with every asset that we have in the portfolio. Our portfolio is predominantly public markets. We do have some private, we have some real estate, some private equity, but it is predominantly public. And the teams continue to look. And the other question we ask ourselves all the time is how much? And at the end of the day, we're a global investor. We need to get paid for the risk. If the risk changes, we need to get a better return. And so we're always asking ourselves, are we getting compensated for the risk? And if we're not, then we'll adjust our portfolio.
It's interesting, the majority of your portfolio is public, but when I was looking into CPP and researching your career, there were a lot of comments about how private investments, and specifically private credit, was the future as to where retirement savings, the investment process for retirement savings needs to go. And I actually, in the last 6 months, I've heard more about private credit than I have in the previous 20 years in my career here at Bloomberg. It's really exploded. Are you still as focused on private credit as you were, before you took over the top job at CPP?
Yeah, I used to run our credit department, so obviously I'm very constructive on credit, and I agree. I mean, just the world is right now really excited about private credit. And I don't want to throw cold water on it, but the world is very excited, and I've heard more about private credit and had more inbounds from other institutional investors on private credit and how we're thinking about private credit. We're the majority owner of Antares, which is a US-based direct lender, so a lot of exposure into
big one.
Yeah, and it's been a fantastic investment and a lot of exposure into the sector. But there's a lot of money in private credit right now, and look at the activity and talking to the team. There are opportunities, but a lot of the historical opportunities in private credit were sponsor opportunities, and we really haven't seen the M&A activity come back to where it was. So when an opportunity does come to market, there's a fair amount of capital that'll move in and chase it. And I anticipate that we'll start to see the M&A market get more active when you actually start to see probably credit get a little bit more affordable. I mean, I'm not sure the model works when the debt stack costs over 10%. And in time, we will need the broadly syndicated loan market to come back. We'll need the high yield market to come back. There'll be plenty of room for the private credit. But I think in the steady state, that's really where you need to be, is have both the public credit and the private credit markets functioning.
But you're not as interested in it right now? I mean, when I talked to people over the last couple of weeks, I said, hey, I'm interviewing John Graham. They were like, oh, you should ask him, when private credit is going to get unstuck, right? Because for at least a year now, we've been in a situation where sellers aren't willing to let go of assets at the prices. It's a very opaque market. There's not really a secondary market. So are you not as interested now as you were in your previous job?
Yeah, no, we're still interested for sure. And it's really what's the opportunity set? And what are the opportunities in the market? And there are opportunities for sure. Our bread and butter at CPP Investments was the sponsor market and really helping and investing in the actual transactions. And that just hasn't been as active. And part of it is, again, if the debt stack is too expensive, there's not going to be a huge amount of transactions. Now, there's another part of the market of more special situations or transitional capital or rescue capital, or and that certainly people are interested in that. It hasn't historically been a big focus for us. We've been more in the sponsor side. And I just say there that that's not a place that you want to probably be a tourist in. If to get into really the special situations side, I mean there's some very capable funds out there, and we'd probably look to partner with them.
How do you see the rate situation right now? When I came in this morning to plan for my 1 o'clock, I do a program with BNN, and we were expecting the Bank of Canada to be on hold, and my producers were saying, this is a good story because the Bank of Canada is one of the few central banks that seems to precede the Fed. Everybody else is a follower. So when they came out with a surprise hike, the markets went haywire. I looked over the 10-year and it was up 13 basis points, the U.S. 10-year, right?
Yeah.
What do you make of the rate situation in particular from the Canadian perspective after what happened this morning?
I've been of the view that the central banks are going to get inflation back to target and do not want to almost tame inflation, that they want to tame inflation. And in Canada, we had inflation coming down and then essentially stalling out. And TIF and the Bank of Canada decided that they needed to hike rates again. So in some ways, I think it's actually consistent with what they've been saying, that they will get inflation back to target.
The markets the markets for a long time didn't seem to believe central banks, and if you look at the WERP function on the Bloomberg, we're pricing in, I think, 2 cuts before the end of the year for the Fed. Even though Jerome Powell comes out time and time again and almost explicitly says, we're not going to cut rates this year. Why do you think a market that, don't fight the Fed is one of the oldest adages in investment, and yet everyone's fighting the Fed this year?
And when I talk to other investors, other institutional investors, and you ask for their view on rates, and what I hear consistently is, we think rates will be higher for longer. But that's not what the market actually says is happening, right? That they think there'll be a cut. So there's definitely a disconnect in what people are saying and what the markets are pricing in. Our portfolio, we actually have viewed it that rates will be higher for longer. And as a long-term institutional investor and thinking about returns over the long run, we're actually comfortable with where rates are today. It was a painful path to get here, but with positive real rates, we're in a better place right now.
I was going to ask you about that. So, I mean, you're in an incredibly important position for the people of Canada. You have, how many people have their retirement savings with you?
21 million.
21 million. So you've got to generate returns, which has been very difficult without going out on the risk spectrum until recently. Are you in a much better position now?
Well, I would say it's a good question. And like many people, I would think we view that returns over the next 10 years will probably be subdued compared to the past 10, 20 years. But I think where we are today is a little bit better than where we were a year ago. We have positive real rates. We have nominal rates higher. We're in a better place today than we were a year ago.
Well, but in the past few years, you've had to take risks to generate returns, and now you have more risk-free return than you had in the last decade.
Yield. You have yield, right?
Yeah.
Yield in government bonds, which we haven't had for a while. And I think about the past 20 years, and we had just so many tailwinds into the markets, right? We had really the secular decline in rates. We had globalization, pretty benign inflation, really benign geopolitical environment, really all constructive and putting a lot of tailwinds into risk assets and across the board, right, into risk assets. We sit here today and rates are higher. The geopolitical environment is no longer benign. Inflation is not something that people are ignoring. And look at anticipated growth rates over the next few years. And growth can hide a lot of sins in the economy. And look at growth rates over the next 3-4 years. So you think about, as an investor, how are you going to drive returns over the next 5-10 years?
So how will you?
Yeah, that's why I'm here. Really a few things that we're focused on. One is diversification. We've spent the last 10 years building out our capabilities across asset classes and geographies, and continue to believe in the value of diversification. Important to have our capital invested in different countries around the world and in different asset classes around the world. We are also an active investor, and we have built the organization to outperform the passive alternative, as pension plans do. And so every dollar we spend is trying to drive alpha into the portfolio. And I say alpha will not walk in the front door. You have to actually go find it. And so right now we expect kind of the beta returns to be a little bit lower than they have been historically. And it's really going to come down to alpha and trying to add alpha into the portfolio.
There's certain places, though, you're not willing to go. I mean, we talked about emerging markets, and I can't remember who coined the term BRICS, Jim O'Neill, I think, right? But there was an R in that term. And you're about the B, the I, and the C when you look internationally.
Yes, yeah.
You don't invest in Russia, even before the invasion of Ukraine. Why was that?
Yeah, we'd made the decision about 10 years ago that we wouldn't invest in Russia. And we wouldn't invest in Russia from a governance perspective. And we weren't making a big statement other than it's a big world. We have limited resources, and we're going to prioritize other large countries. So we didn't do direct investments in Russia. So when Russia invaded Ukraine, we had no direct investments in Russia to deal with in the portfolio, which was, a great place to be. And sometimes the best decisions you make are what you decide not to do. And the other kind of pitfall we avoided last year was crypto. And we'd spent a tremendous amount of time trying to understand crypto. We had a lot of our colleagues who were really enthusiastic, but we'd never taken that leap of doing direct investments in crypto, which I think saved us a lot of time through the back half of last year.
Even though you had the legal ETFs to do it, It's funny to me what you're allowed to do in Canada that you're not allowed to do in America. I think about weed, I think about crypto, but we won't talk about that. The interesting thing is that you didn't go into Russia, and I would think that it was a value judgment, not in terms of valuations, but in terms of ethical values, right? Was it all related to the lack of the rule of law, the problems in investing in a country that had annexed Crimea already?
Yeah, and this was long before that. I mean, we're talking 10 years ago, before the annex of Crimea, and it certainly was through a governance lens. And I know ESG is a very politicized term, but it was certainly through a. I know. I figured that's where you're going. It's certainly through a governance lens of from a risk-adjusted return. We're just not going to get compensated for the risks here, and plus, again, we saw better opportunities in other places.
So, this morning when I came in, we had a bunch of protesters outside. It was kind of an ESG thing. They were angry that TIA, I think, owns fossil fuel assets. How do you look at ESG, which there's been an amazing backlash on this side of the border over the last year, but it seemed like something that was going to drive the investment environment, still may, in the years preceding that.
It's been interesting to watch, and it's been interesting to watch the backlash. And maybe I'll just share a little bit about CPP Investments on that. We were actually created through an act of Parliament. But people often ask me, what's the secret to your success? And I think the organization's been very successful. We have a 10% return over 10 years, so a 10% CAGR, and the portfolio is $570 billion. And the two components that I think are the two key kind of contributors to our success is, first, we have political independence. We have no government involvement in our investment decision-making. We operate completely independent of governments. And two, we have a single fiduciary mandate. We are there to maximize return without undue risk of loss, taking into account the factors that impact the plan. And we do it in the best interest of the 21 million Canadian contributors and beneficiaries. We are there to contribute to financial security and retirement at a time when people may be in their most vulnerable part of their life. And that's what we're there to do. And as we think about the return of the portfolio, we do think non-financial considerations such as ESG actually drive value. Governance, right? We should invest in companies that have board of directors. We think on the S side, companies that respect human rights, respect the environment, I think there's actually a tremendous investment opportunity as the economy tries to transition to net zero. And we've looked at ESG and say, based on who we are, what we're trying to accomplish, let's calibrate this to who we are. And so I think most investors incorporate ESG into their investment decision making. We certainly do, but we calibrate it for who we are and what we're solving for. We don't buy a product. I think it's very hard to buy a product called ESG, but we certainly embed it into how we make decisions.
Let me finally ask you about the CAGR that you mentioned. I was looking over the numbers, and in a lot of quarters, you were much higher that I was tracking, 11.3%. Is this decade going to be worse, you think, than the last decade? Are those numbers going to be lower?
And that's what I was alluding to earlier. I mean, I think we certainly benefited over the past 10 years from some of these secular tailwinds. And as we look, we still see interesting opportunities. But I think we would expect the returns over the next decade to get back to more longer-term averages. We think probably the last decade was actually a little bit above average.
All right, John, thanks so much.
Thank you.
I appreciate it. John Graham from the CPP. Thanks so much. I'm just going to do some closing remarks here. Appreciate you all joining us here at Bloomberg Invest. The program, of course, continues tomorrow, as I'm sure you know, and I want to thank all of our speakers, our moderators for the program that we've had today, which has been really amazing. I want to thank also our sponsors, U.S. presenting sponsor Invesco QQQ. Actually, I looked over the last 5 years, 10 years, and 15 years. The Qs have outperformed every single growth fund manager that we track, and we track them all. Our presenting sponsors, Allspring Global Investment, Neom Principal Asset Management, and our participating sponsors, Southern Company, as well as the Glenrothes Single Malt Scotch. And this is what I'm pretty excited about for making this event possible. If you want more information about our sponsors, you can click the Resources tab on the event website. And we're not done yet. We hope that you can join us in person or virtually for another day of Bloomberg Invest. Where's the camera there? We have a great lineup. Tomorrow, Goldman Sachs' John Waldron's going to join us, Universe's Nassim Taleb, and TCW's CEO, Katie Koch. And for those of you who are with us in person, you can join us for networking, refreshments, and light bites outside these doors. Proudly sponsored by the Glenrothes Single Malt Scotch Whiskey. The Glenrothes has been producing some of Speyside's finest single malt Scotch whiskey for more than a century. And today, you will have the opportunity, I saw them pouring some snifters out there, to try their winner of the best Scotch in 2020's Ultimate Spirits Challenge as you exit the room. And by the way, if you have registered to attend the Odd Lots live taping tonight, proudly sponsored by the Principal Asset Management this evening, please make sure that you arrive downtown no later than 6:45 p.m. because they're going to close the doors promptly at 7 p.m. Joe and Tracy are not going to allow anyone in after that. So if you have any questions, please make your way to the Principal Asset Management's branded column outside these doors, and someone from Bloomberg will assist. Thank you very much, and breathe well.
together.